Good morning, ladies and gentlemen. It gives me great pleasure to welcome you all to Edelweiss Presents the Economic Times Remodel in India Asset Reconstruction and NPA Management Summit 2017. At the outset, I'd like to request all of you to kindly place your communication devices on silent mode during the course of this summit. Thank you. I'd like to take this opportunity to thank our partners for this summit, presenting partner Edelweiss, associate partners State Bank of India and Trilegal, live webcast partner 24 Frames Digital. You can also tweet about this summit using the hashtag #ETRemodel The Economic Times recognizes the compelling issues in asset reconstruction and loan recovery, which is a building block when it comes to India's growth. The Union Budget this year includes some important provisions to help banks recover bad debts. Also, the entry of stressed asset funds in the Indian market, value additions of banks and asset reconstruction companies will mean lesser NPAs and greater economic growth in the future. Given this, I now invite Mr. Aman Kanjlia, Senior Director, Conferences, ET Edge, to deliver the welcome address. Ladies and gentlemen, kindly put your hands together for Mr. Aman Kanjlia.
Good morning, ladies and gentlemen. It gives me immense pleasure to welcome this august gathering of distinguished speakers, industry experts, leading bankers, asset reconstruction companies, law firms, credit rating, and other financial services companies to the second annual Remodel in India Summit 2017. Just recently, I was skimming through the newspaper report of RBI's move to set up an agency to deal with bad debts of banks. And I thought to myself that this should be a good time to organize a gathering of all stakeholders to discuss the compelling issues in asset reconstruction and bad debts recovery. Attachment of assets, notable defaulters, and other stringent actions in the last 1 week resound the theme of our event, Reimagining India's Growth. As we talk of exciting developments in the area of bad debt recovery, I am sure that you are all keen to know about the investment opportunities of asset management companies in bad debts through stressed asset funds. We do have experts from AMCs to enlighten us on this today. The Union Budget has brought much cheer to this segment of financial services. With recapitalization for public sector banks and the proposed law against defaulters, we look forward to hear from the expert banker in the panel discussion on the NPA resolution schemes and the positive outlook for the future. Asset reconstruction companies and law firms will be discussing about the changing roles and value additions in another panel discussion today. Case studies and presentations of other speakers will broaden our understanding of the evolution in this space. I hope each one of you will be able to enrich your knowledge on the latest developments about financial services and enjoy these sessions. Do make the best use of knowledge sessions and networking opportunities of the day. Thank you so much.
Thank you, Aman. It is my pleasure now to invite on the dais Mr. Abhizer Divanji, Partner and National Leader, Ernst & Young India, to deliver the keynote address. Ladies and gentlemen, kindly put your hands together for Mr. Divanji.
Thank you, ladies and gentlemen. It indeed is a pleasure to be here in front of all you bankers, ARC people, alternate asset providers, and everybody else. And I'm glad that asset reconstruction and NPA is actually being considered as remodeling. Frankly, it needs a lot of remodeling as we go along. As I deliver and as I saw the agenda for today's session, we have a set of alternate capital providers who come in first. Then we have the ARCs, and then we discuss exactly with the bankers around how asset reconstruction can be done. Now, just the two bits. I have been associated with asset reconstruction for the last 2 to 3 years, and we have been dealing with a lot of companies having on-ground experience. Just a few things for this conference today to deliberate on. One is, what is the cause of NPAs in our system? And I'd like to kind of spend 5 minutes on the causes of NPA. Our system was no different until 2007. The world grew, India grew, we were all very happy. 2007, when Lehman Brothers happened, the world fell apart. But India thought that we were a decoupled economy. We were not linked with the rest of the world. Hence, our asset creation grew. Our loans to the banking system, the loan growth in the banking system, was 26% in the year 2007, 2008. 18% or 19%, I think, in the year 2009. Despite the world degrowing, our economy grew at 7%. Our businessmen were easily getting money. Why? Because the banking system was pressurized to grow at 26%. Because one bank grew, the other bank had to grow. And I know for a fact, if you talk to promoters today, there were a queue of bankers outside everybody. 2007, 2008, when the world was falling apart, offering money. Great. What did the promoters do? Bought real estate, invested heavily in capacities, said that let's do the carry trade because internationally rates have crashed. Why don't we try and make some money out of borrowing dollar, borrowing yen? Because the Indian rupee is strong, Indian economy is growing, is decoupled. Indian exchange rate will remain stable, everything else is falling, let's take advantage of that. That's what they did. Then they said, there's so many assets going a-begging. Why don't we go and buy some of these assets? Because we have the ability to turn it around. We have the strong financial position. We have a strong domestic market. Let's go venture into international markets. That's when people started buying plants in South America. People started buying plants in US, in Europe. But what we did not realize is that we were a coupled economy. And frankly, come 2010 or 2011, we realized that we were not. And we were facing the stress. Our economy started facing stresses. Our carry trade started going the other way. People may remember WOCAD. Our carry trade started going the other way. The international operations which we expected we could turn around, we could not because we were no different than any other promoter in Europe or any other company in Europe or US. So those operations effectively had a problem. And domestically, we had a policy paralysis. Risk cost. We had a good 4 or 5 years, in my opinion, where the incremental credit growth, if one were to analyze it, went to pay interest. We had CDR mechanism in place. We had various other mechanisms, restructurings with the provisioning norms that had relaxations. We could do restructurings. We did them. We funded more interest. We made grandiose plans that India will continue to grow. In hindsight, 2020, these are the issues. So really we built on, and today if you look at the total outstanding, in my opinion, I don't have the numbers, but in my opinion, easily 20 to 30%, or even more, maybe 30, 35% of the total outstanding today is nothing but funded for interest. So we have that component sitting in our balance sheets. This is really where the articulation of the problem is. So today, we have a situation where in 2016 or 15, the RBI did an AQR, the problem came to surface, and we had bad debts which rose significantly. Today we are at 2.x% gross NPA. And that is in a way a real situation as of today. But if you look at RBI's own projections, 2018, gross NPA is expected to be 12%. So congratulations, it's a growing market. But the issue is that there needs to be active resolution. And I mean resolution, which is required. And the credit, which earlier went for interest, ought to go for active resolution. So what RBI has done in the interim to resolve some of this, they came up with good amount of schemes. So first of all, they said CDR is disbanded. And not disbanded. The provisioning advantage to CDR has been disbanded. People can still do CDRs if they wish to. Then they said that we will introduce newer schemes. So a change of control scheme was introduced called SDR. So SDR effectively said that get a new promoter. We will do any kind of restructuring you wish. Make sure the loans are paid. Yet nobody was willing to write off loans. We will restructure those loans. Come a new creditor. Maybe a little bit of discount we will give. That process went on for some time. We did not have too many bidders. I've yet to see one full 100% successful SDR. There's one happening right now in the south. But that's about the only one that's really happened. Then they came up with another scheme as a rejoinder to say, fine, if there are not going to be enough promoters, let's have another scheme which talks about retaining the promoters as long as the sustainable debt is of a particular size. So the definition was 50%. If 50% of your debt is sustainable, we will keep the promoter intact. The balance 50% we shall deep restructure, and you go on. That was another scheme. That was a little more successful than the SDR scheme, for the simple reason that the promoter was not dislodged. But the disadvantage of the scheme was that very few people actually fitted into that. Given the fact that we already had a bloated loan position, given the interest accruals being added onto loans, we had undercapacities because of the consistent pressure that corporates formed. So corporates were operating at 30-40% capacity, which I think was a much needed one. The insolvency code came with a few principles. The key principle there is failure is acceptable. Now that has to be deliberated in the Indian system. Because in the Indian system, until now, or even today rather, failure is not acceptable. A business failure is simply not acceptable. Because the first thing that the banks want to do is a forensic review and try and nail somebody down. Nailing anybody down never revives a business. Even the code, there is enough misconception today that the insolvency in the bankruptcy code is all about liquidation. It is not. If you look at the iterative process under the code, the very first thing it talks about is revival. It talks about provision of capital. It also talks about building about stability. That's why the insolvency professional exists, because he would not think hockey stick like a promoter, but he may think stability first. He may moderate expectations. He may be able to use available finances much better than what a promoter would do. He would be much more dispassionate. That's the expectation. So it's about revival, stability and revival first. And if that option is not acceptable, then liquidation. That has to be very clear to everybody. And that's where the role of alternate capital providers, asset reconstructors comes in. Now, having said these things about the economy, let me also tell you a few positives. The reality is, India is still expected to grow at around 7%, which is not bad. India still has capacities which are needed but are not yet ready for use. India still has a need for incremental capital to sweat those capacities. And frankly, if this gathering here debates and deliberates on how those capacities can be sweated, that's where the opportunity for revival is. And that is the much better opportunity for revival than any liquidation. And today, India is at the threshold. It is the largest growing economy in the world. Why would there not be opportunity? Now, talk about our sectors. Steel. Despite the cyclical issues in steel, if there is strong long-term capital available, steel can be revived. But there is capital required to get the plants up and running. We faced turmoil, right? There's coal allocations which got cancelled. There are iron ore allocations which got cancelled. It disrupted the industry, apart from the fact of the macroeconomic issues. But domestic demand has been sustained with the minimum pricing. Frankly, there is scope. Take EPC. EPC was one of the companies which got impacted when people took very aggressive EPC contracts because money was easily available from banks. But is that government spending? Look at the current budget, 2.4 lakh crores in government spending. Will that not result in EPC work? Of course there will be. But will the EPC guys need capital? 100% they will, because today they don't have it. And in an EPC business, unless you provide working capital, unless you provide bank guarantees, unless you provide hardcore money to grow some of those assets and remove them from the stalled situation, there will be revival. The biggest issue in EPC is claims. Because everything does not go to plan, and there are claims. And government does not pay those claims effectively for a very long time. Those result in working capital cycles being longer. And if working capital cycles are going to be longer, somebody needs to fund them. I mean, today an HCC asset became a success because the government decided to convert the loans into guarantees and release the cash back. That's how the working capital cycle has shrunk, by converting a funded facility into a non-funded facility. That's all that's done. But that has brought down the cost and that's provided liquidity. Similarly, somebody needs to provide liquidity. If India has to grow, 2.5 lakh crores has to be deployed by the government, and I think credit growth will be government-led first and then industry-led over a period of time. But that is the requirement going forward. So EPC will revive that way. So there is opportunity for EPC because of government spending. There is revival of core industries like steel and cement. Cement is anyway revived in a way, but cement is one of the good assets that people end up selling to reduce their debt burdens. Real estate is another one. And with increasing real estate advantages with shops coming in and low-cost housing, etc., there is a significant need because there is a latent need. There is housing required in the Indian system. So there is demand. Now, coming to the bank side, which is a real problem, which is again a point of deliberation. Do banks have the ability to right-size debt? Did a small analysis. If you look at it, gross NPA today in the system is 9%. I'm talking about today, September 16 numbers is what I'm saying today. 9%. Net NPA is 3%. So we have a 66% provision on NPA. NPA declared is around 6 lakh crores. So on 6 lakh crores, roughly, we have a 66% provision. Estimated stressed assets in the system, if you were simply to include the restructured assets, is roughly 9 lakh crores. Could be anywhere between 9 and 10 lakh, take a guess. Say 9 lakh crores, let's take the restructured number as per the government. On that, there is certainly a 15% provision minimum, but that's a requirement. So if you take 15% on 3 lakhs crores and 66% on 6 lakhs crores, your weighted average provisioning is roughly 50%. So banking system today does not need capital to the extent of providing for 50% of its assets, 50. With budgetary allocations and with some kind of capital rationalizations, including the tier 1 bonds that they do, I think there will be an ability to go to 60-65%, which is a pretty good number, frankly. Of course, the big challenge is, given the recent developments, will banks actually convert provisionings into write-offs? Question. But I think they will do it. I think the positive part is that with things like the IBC coming, where the decision making becomes more transparent, becomes more covered, with the legal system also looking at it, I personally believe banks are headed towards resolutions and converting those provisions into write-offs or some kind of preference shares or some kind of obligation which is inferior to debt. And if they end up doing that, frankly, there is a big opportunity that stares us in the face. For the alternate capital providers, who, and I would include private equity guys in that, they've historically taken minority stakes, come into businesses, had bought positions, and generally been passive. This is their opportunity to come in, take majority stakes, because frankly, almost every promoter now is very happy with a significant minority, because they want to save their businesses first. So you come into that position, invest your money in, retain what I call as the promoter's pride, because if you give that away, if you treat him badly, there's going to be retaliation. But if you treat him well, and he knows his limitations, I think you're there. Also, if you give him a little bit of an upside to basically get some benefit of helping you turn around that business, that will be an additional help. So if you look at it, there is a conciliatory approach along with the existing promoters to smoothly transition a business. There is control available. There is higher stake available, and that is true private equity. I personally think even things like ARCs, and you can debate it. The last point I'd like to make, frankly, before I go off, is until now, resolution was very accounting driven, and I'll define what I mean by accounting driven. The biggest consideration was, what kind of provision do I need to take? Do I turn into an NPA? ARCs will be redundant because, after 1st April, the provisioning norms are similar whether you sell to an ARC or don't sell. How does it matter? Because provisions are already made. You still have an option to go through an ARC or not go through an ARC. What it says, at least from 17 to 18, the rule says that of a transaction, 50% should be cash, 50% should be ARC. As long as 50% is ARC, I will allow you to recognize that as a true sale. If not, please provide as if the loan was never given. That's what it says. RBI is only having provisioning norms to protect the resilience of Indian balance sheets. Why would we want that to impact resolution strategies? And with a 50% cover going on to a 60% cover, we should be less bothered about it. And the minute we are less bothered about it, we will focus more on resolution and less on accounting. And that is where our answers will come about. So with that note, I think there is a lot of opportunity in the industry. As we look at it, it's 9 lakh crores worth of booty available to revive. And I would wish this seminar all the best in terms of discussing how best to do it. Thank you.
Thank you, Mr. Divanji, for your keynote address and for setting the tone for this summit and the proceedings to follow. I request Ms. Archana Tiwari Naidu, Content Head, ETH, to present a memento to Mr. Abhizar Divanji as a token of our appreciation. Thank you, Mr. Divanji. Thank you, Archana. We now move on to the first panel discussion for the day, titled Driving Up from Being Dragged Down. I'd first like to welcome on the dais Mr. Rajat Bell, Director of Financial Sector Ratings, CRISIL, who will be moderating this session. Mr. Bell, if we could have you on the dais, please. I now welcome the other panelist, Mr. Amaya Kanye, Partner Trilegal. Welcome, Mr. Amaya. Mr. Devendra Prasad, CGM Stressed Asset Management, SBI. Welcome, sir. Mr. Nikhil Srivastava, Director, KKR Special Solutions. Welcome, Nikhil. And Mr. Karthik Subramani, VP Brookfield Asset Management. Welcome, Karthik. Please hold your questions. There'll be a Q&A session at the end of the panel discussion, so kindly hold your questions till then. Rajat, over to you. Thank you. I'll keep it in this pocket here, to the right side instead of the left side. Thank you.
Of course you have. Great, thank you so much. Morning, everyone. We had an excellent presentation or talk by Mr. Divanji to begin with. He brought out quite a few pertinent points, and I'm sure the distinguished panel here will be able to add to that and bring some more light and color into some of the points that he brought up right up front. As one of the things that he pointed out is the opportunity that's there for the stressed assets players, whether you call it ARCs, stressed asset funds, and so on. But obviously, all of it stems from what's happening in the financial sector and largely in the banking sector. So just to give a little additional flavor to some of the numbers that he mentioned in his talk, 6 lakh, 9 lakh crore, which are the stressed assets. Our estimate is that about 8 lakh crore would be NPA by the end of this fiscal year. And to add to that, something that we define as weak assets or stressed assets or multiple names for it, that number could be around 10 lakh crores. And the question that keeps coming up and a lot of people keep asking is, are we at the end of this cycle? Can we start looking up? We believe that there is still some stress, and so there is role for stressed asset management that's going to continue. Is the recovery something that's possible? Definitely. There are a lot of steps that are being taken to aid this recovery process. The current estimate that we have about another 1.5 lakh crore of just the large corporate assets that could be stressed and could turn NPA, right? So it's not that banks necessarily are in a position to handle such large accounts, so many of such large accounts, and an increasing stress in the MSME sector on their own, and they can get all the help from the other players in this segment. Having said that, both the regulator and the government has taken a lot of steps. There are a lot of tools that are available even to banks currently, and some of them are being used. Some are effective, some need probably some more adjustment before they can become effective. We've seen CDR in the past, we've seen 525, we've seen SDR, and the latest one being an S4A. So multiple tools are there. If used effectively, they can yield good amount of result. But then we've seen in the past ARCs playing a role. We've seen a lot of assets that were sold to ARCs. There are challenges in that, and some of them developing challenges also. So we will probably discuss that in this forum. But without further ado, let me move to the core issue, which is what's happening in the banking system and what the banks can do themselves to sort of resolve some of these stressed assets before we can look at the role that the other players have. So if we can get Mr. Devendra Prasad involved in this, sir, how do you see the stress that's still there in the system, and what role are the banks playing in trying to recover, and how do you see the environment that's there currently, and do you believe that there is sufficient space for banks to be able to recover a lot of this from the stress that's there currently?
Thanks, Rajat. First of all, whatever I am expressing is my personal views, not of my bank. One, I'll respond to you in the three parts. One is, what is the status of stress level in the banking sector today? The numbers are already in the public domain. It varies from officially 6.3 trillion rupees NPAs. If you add about 2 odd trillion for stress assets, it becomes almost 9 trillion. And the stress are those which are not exactly NPAs, but facing different levels, different intensity of stresses. As per the system, we have, as per the regulator's guideline, the reporting, monitoring, supervision, all these things are there. And all the banks are monitoring as per those reporting and credit flow, end use, all these things are there. But the problem starts when perhaps there is some stress in the economy which has impact on the corporates, whether it is mid-segment, whether it is large segment, or even SMEs. If you look at a little bit of history, in the early 90s, the NPAs were at the tune of almost 20% plus. Then it came down to about maybe 7, 8. Then 2007-8 happened. That was the time when the banking industry, particularly the public sector banks, had to take a call whether we'll allow the economy to flounder, whether we'll allow the companies to die, or to try to revive them. The stress that we are seeing today is largely post-2008-9 crisis, 7-8 crisis. Now, the second is how we are responding to that, as I said, from the day one when a loan is booked by the banks. The monitoring and supervision starts. When the stress emerges, is seen, the reporting starts. And, of course, credit flow control supervision is a part of the system that we are following. And I believe the banking industry does also follow the same system. But still, there is a stress. From stress assets, they move on to NPAs. But why this happens? It could be, as I said, stress in the economy, maybe some policies. Iron ore, something happened in telecom, spectrum, distribution, allocation. All these policies have impact on that particular sector, as a result, also on that particular industry. Second, could be some sort of imprudence somewhere, corporate imprudence. Sometimes, perhaps when even there is an overcapacity, we still go in for creating more capacities. Third thing could be whether, normally as it happens, say for example in iron and steel, we say the Chinese imports from China is actually killing our industry. But why? Are we able to improve our operational efficiencies? Can we cut down on the over-leveraged companies? Because debt is a carrying cost. Debt involves carrying cost. Can we cut down on that through operational efficiencies? Third thing, which is part of the operational efficiency. Normally, even in household savings and the budgeting, we have some savings for the rainy days. Are we doing that? Basel does also talk about some sort of provision for buffer. Do we do that? Perhaps we don't. And the last element is maybe, again, that comes to the malfeasance or fraud or all these things happening. So these are the cumulative impact of the economy and interplay of some sort of corporate behavior. Now, how do we solve this? As Rajat has mentioned, attempts have been made, all, I think, beginning from CDR, then 525 and all this. It has limited impact, but why? To me, it seems that by the time an account is ripe for treatment of such type, the interest burden is too high to be serviced with the present capacity. That is one. What is the solution? Are we going to create more capacities in the already over capacity economy? Perhaps not. Then where's the question? Where's the answer? We have to improve. We have to cut down on the debt burden. How do we do that? We can convert it. Somebody will have to take a haircut. The banks have been taking haircut. Perhaps some of the stakeholders are not prepared to take that much of haircut that perhaps is required. We have experiences whenever there are, I think, stakeholders from governments are involved, perhaps I think they have their own compulsions for not. Even extending minimum percentages of the support. Perhaps, this is my personal way, as I said. So to me, it appears to be the real challenge. Now about the IBCC code, I see it is as a continuum. We had DRT, SURFACE, then IBCC. Recent amendments, both in DRT and SURFACE also. It's a good beginning, I would say. But again, the challenges are many. The benefits are, one, sorry, it's not dependent on the corporates. Once a professional has taken a call, and NCLT had decided that it's a fit case for revival, everybody will have to fall in line. So that is the one good part of it. Earlier we had all these, what I have spoken about, S4A or this thing. This had to depend on the consent from the owners. So that is missing, one. Secondly, we have timelines, 180 days plus 90 days. Either it is revived or it goes for liquidation. Third thing is that perhaps with some professionalism, because all these units, if it is approved, the plan is approved, have to be run by a resolution professional with a team of the Committee of Creditors. So it's a professional body purely, not the management of the company. So that problem has been taken care of by substitution or handing over the control of the management. So these are the three good points, it appears to me. On the flip side, as I said, we are adept in creating institutions. But it is difficult, what we have seen in DRT, for example, it is difficult to run those institutions. Maybe the process flow will have to be streamlined. It has to be like a very, very compact SOP type, where if some information is required, we have a provision for information utilities. And again, I don't know how much time it will take actually to get operationalized. Similarly, the case with this insolvency resolution professionals. But having said that, we'll go by what the intentions are, and the intentions are excellent. It will take some time, maybe 2 months, 3 months. But once it is done, we are confident that there will be a clear-cut segregation between the companies which can be revived and companies which have to come to the liquidation part of it. Although the liquidation process can be extended up to 2 years. But if you look at the almost 5,000 plus cases pending in the different courts in the country, high courts, for winding up. So I believe that this IBCC code is going to be a great help, provided the structures which have been notified have been put in place. There's a provision for 10 NCLT, 10 or 11 NCLTs. If all these infrastructures are in place, maybe in the next 2-3 months' time, and add to it the economy picking up. If you have some numbers on the NPA numbers which have come through the December quarter balance sheets of the banks, it seems to be stabilizing. So it has to be interplay between the improvement in the economy, the infrastructures in the legal system, playing up in a most efficient manner, and we are confident that this is going to be a good time so far as improvement in the asset quality is concerned. Thank you.
Thank you so much. So an interesting point that Mr. Prasad brought out is there is an improvement that he's seen in the legal framework, and things have started looking up. So just taking that ahead, if I can bring in Amay into the discussion, as he's been in the core of things from the legal side, and if we could talk about how you have seen the legal framework change, and do you see concrete improvement in the way things have been working, and what more do you think can be done to strengthen this further that will aid this entire industry?
Sure. Thanks, Rajat. So I think I'll also contextualize it from what Mr. Prasad just outlined. And in terms of intent, we have, of course, seen, the DRT back in the day was set up as a dedicated body to fast-track resolution of banking cases. Then you had the SARFAESI. Following that, we have a range of RBI-related measures such as the CDR, SDR, and S4A kicking in. But if I were to just spend a few minutes analyzing the success story of all of these, I think if we may face the reality and accept that some of these have not really delivered the success that they ought to, it's not because of the lack of the legislative framework, but it's more at an administrative level. And when we contrast the IBC with some of these legislations, clearly they bring in some very, very useful tools for the first time. The cautious optimism that I hold for the IBC will have to actually, is on account of the administrative aspects of its implementation. Now, from what I understand, if you actually look at NPA resolution over the last 2 or 3 or 4 years, it may have actually declined over the last 2 or 3. Maybe it was a little more, the level of NPA resolution in 2013 was a little more than 14, and perhaps, which in turn was a little more than 15. So clearly, this problem of stressed asset in our system is increasing. I think one of the first limitations on why that might be the case is if you look at the large, and it takes me back to what was mentioned by Mr. Devanji a little while ago, that the resolution strategy perhaps has been driven in some part, perhaps from an accounting perspective, provisioning perspective, perhaps in more measure than a resolution perspective. That's point number one. So, one questions whether the right level of motivation or attention has been brought, or the right factors have been considered when some of these cases have been put through these the discourse of CDR and SDR not really, but CDR and JLF and so on and so forth. And which is why a lot of these cases have come back into distress or have continued their stress and are being restructured, for the second time over or third time over. The second aspect is the number of stakeholders, the category of stakeholders that are involved. So, in many of these cases, even if there is a resolution strategy, there is a set group of stakeholders that is determining the fate of these companies, divorced from several other set of. So, if you look at CDR and S4A or JLF, for instance, none of the foreign bondholders have ever had a seat at the table. None of the foreign creditors have had a seat at the table. So, we have more often than not seen instances where, on the one hand, a large group of banks are trying to sustain the operations of the company, subjected to financial restructuring at an entire balance sheet level, but really without having all the stakeholders. So, there's another set of stakeholders who are winding up petitions. So, it's extremely common now to have CDR and SDR or whatever process is happening on the one hand, which is contractual, and a set of maybe a bondholder or a foreign bank who doesn't have a seat at the table completely being ignored in that process, and therefore pursuing his own independent legal remedy. So there are conflicting remedies being pursued in some of these cases. We've seen instances where resolutions requiring asset sales have been injuncted on account of some of these measures. We've seen cases where the entire processes have been injuncted in the past. To my mind, I think as a legislation, the IBC is extremely welcome on a number of these counts because it addresses the fundamental issues that may have, been limiting some of these previous measures. So first of all, instead of it being a contractual process exclusively between banks and the borrower, in fact, or if I may say, some section of the creditors and the borrower, it is now a judicially administered process. So I think that's the first advantage. And in doing so, what it has done is it has brought every single creditor onto the table, on the same table, to discuss what is the best resolution strategy for that company. So in that sense, you have people working towards a common cause with everyone having their own say, because why should there be a difference between a foreign creditor and an Indian creditor for that matter? Let them all have a say in that resolution process. It's of course very welcome that there is a fairly aggressive and a speedy timeline that is attached to the process. Now, how it plays out, whether it, unlike the DRT, whether a mandatory timeline becomes a directive in the timeline remains to be seen. But I think the success of this process hinges in very, very critical measure on these timelines being honored. So we'll have to have the framework that allows for those timelines to be honored. There is a fair resolution process by an independent third party like an IRP. So even if you have a dissenting creditor, you know that you will at least have a liquidation value emerging for that dissenting creditor. You have an absolutely well thought through, taking from international experiences, well thought through administrative backbone that is backing up this. So whether it's the insolvency resolution professionals, whether it's the IPA, whether it's the information utilities as and when they get set up, it's done all the right things as a legislation. And last but not the least, the grounds of challenge again are fairly limited. It is due process related. I don't think you can question, what is the resolution strategy that has been brought in, and that's also important for this to move on. So this combined with the swim or sink and not the other way around. It's a marked change in the approach of legislation. So I think all of these give you the right platform. But if I may come to the word of what makes me cautious is whether we are going to take the right administrative steps to whether we are going to back this up suitably on the administrative front. So what it needs is the right qualification for the IRP. You need the right number of IRPs with the correct qualification to be able to see these through successfully. You need a deep enough infrastructure of well-trained judges, well-funded institutions to have the right kind of IU in place, to have the right administrative support system for those IUs. So I think these are things that will also have to be thought of. And one way, for example, is you create a fee structure within this mechanism which funds the administrative backbone of this. So let the fee, for example, instead of a separate fund, let there be a decent fee, a reasonable fee, which can actually go towards funding some of these administrative costs, and then deploy them into setting up the judges with the right kind of compensation structure, with the right kind of training facilities. And it's only then that we'll see the success of this architecture really sort of coming through in the right measure. So I'd be interested and optimistic to see that hopefully the right steps are made, and if they are, then there are a number of other aspects that play well into the field. Whether it's ARCs now with majority ownership there's enough sources of foreign capital coming in. There's distress funds coming in. There's ARCs who have majority ownership. These are all players who can feed in extremely well in providing the right solutions for some of these turnaround or resolution cases. So I think that's I'll leave it at that for now.
Great, thanks. So that's some good news. At least we believe that the framework, the administrative framework has been, we've tried to put it in place to take things ahead faster than what we've seen in the past. And now it's all about operationalizing it and implementing it in the right way, having the right manpower with the right capabilities and capacities to be able to bring it to fruition. An interesting point that you brought out in your talk is sort of what has been the experience of the recovery in the past and what role the ARCs have played and the framework that's been there. So with that, let me bring in Karthik into the discussion. We've had, even our experience, what we've seen is the recovery that's been there or resolution that ARCs have seen in the assets that they've bought has not been too great in the past. We've had maybe about, close to our experience shows that data shows about 50% is the sort of resolution that happens. And so players have always been wanting that from the bank side that the resolution should be better. There doesn't, in the past we haven't seen a middle ground. We've had ARCs complain multiple times about the valuation expectation from banks, coming to a middle ground of the expectation on how much the recovery could be and hence what the pricing should be and so on. Those challenges have been numerous in the past. You've been a part of the stressed asset sort of in the past here and also globally. So if you could throw some light on with how things have been in the past to how things are changing now, do you expect that we could see a further participation of stressed asset funds, ARCs, into this entire picture with the clouds sort of moving away, and you could expect better recovery and hence larger participation? As Amey mentioned, there doesn't seem to be a scarcity of capital as of now. There are multiple funds looking to come in, but do you see enough opportunities in terms of right valuation to be able to participate effectively in this?
Sure. So, just stepping back, few years back and how the ARCs have operated. We don't have one ourselves here in India, but just noticing how they have operated. It's been a fairly small capitalized base, maybe about 3,000, 4,000 crores, and effectively they can take control of assets that are worth about 20, 25,000 crores. Business model, I guess, everyone has, been privy to it. And because of the economics of the business model itself, it made sense for them to, do the 595 and be able to, control assets with, very little capital, but being able to recover, the capital invested by the fee that they make itself. There have been changes and which are very promising in terms of regulatory changes, which Amey highlighted. The change was, from 595 to 1585, and then there's more, capital at risk for them, and they'll sort of think twice about deploying capital within such situations. Having said that, I mean, the capital base is still not increased, and that's something that continues to be an issue. And there's one of the main reasons why things haven't been sorted out at the ARC front, at least from our sort of limited reading, is because we're not really focused in the past on operational turnarounds. The business model has primarily focused on aggregating debt and then trying to sell off assets in a disaggregated manner. Why does a business go into stress in the first place? Right? I mean, you can call them distressed assets funds or ARCs. They're all tools to be able to turn around businesses. And we as investors, as would I'm guessing many others, would think of businesses, industries that are sustainable, where you can generate cash flows over the long term. There's certain sets of issues either in the regulatory framework that have happened, sort of panned out in the past, which have impacted businesses, have drained them of cash in the interim, which requires a recapitalization of the business. So, a restructuring can be a mix of both financial and operational, like we know it. On the financial restructuring aspect, I think banks have been pretty progressive. The RBI and its with Dr. Rajan has made substantial strides forward in ensuring that banks think about and are encouraged to think about provisioning adequately, and they actually think about how they resolve their assets now. So the financial restructuring aspect, and I'll sort of touch upon shortly as well, won't be able to diverge too much, but we have a partnership with SBI as well, and as part of that partnership, what we're looking to do is work together to figure out how we solve some of these stressed asset issues within the system, and this is not related to the SBI loans alone. But you need a lot of these partnerships that will encourage banks to think holistically and about long-term sustainability of businesses, which will also help them size loans accurately, sustainable levels of loans going forward. I think we've seen a sea change over the course of the last 12, 24 months in terms of how banks are approaching financial restructuring, which is again a very big positive. Earlier on it was just about going through CDR and then deferring the problem versus having to handle it head on today. But there's been a sea change in terms of the thought process within the banking industry itself, to address these problems. The problem, today that I guess the industry as a whole is facing, not just the banks, but generally, we talked about talent for resolving some of these loans. I think the issue is the operational restructuring, right? End of the day, this is sort of a first time in history, I mean, if you may, where the issue that issue of NPAs has grown substantially, and as a consequence of which we don't necessarily have the right talent to operationally restructure some of these businesses. And what, like, I mean, maybe it's just a situation because of which approvals, for instance, because of which certain projects failed, thermal power plants, for instance, or coal linkages. But so maybe the existing management is well suited to run these businesses going forward if the environment turns well and everyone's supportive of it. There's capital available. I guess the important aspect here is for us to think about is how do we operationally turn around businesses? Do we have the right set of people either within existing management or that are externally available that can help fix these businesses and resurface value over time? And that's something that we are focused on going forward. We don't really think about ARCs or any other tools. I think we are generally positive about the regulatory and legal framework that has developed over the course of the last 12, 24 months. We think it's really encouraging. It's sort of a one-stop shop for all sets of issues. I think the template exists now. I think the next steps need to be in terms of how these are implemented that will facilitate transactions to happen. The NCLTs need to show track record of having helped funds transact or businesses transact, and that will give confidence to people in general in terms of the transactability of certain opportunities. And after you've transacted, of course, you need to have thought about financial and operational restructuring. I think the banks are getting there. They need comfort and encouragement in terms of what are sustainable levels of debt. So there's got to be guidance, and there's got to be an individual sets of professionals who are able to value these businesses in the correct fashion. Again, so that banks can upfront, be confident that these are the levels of debt that are sustainable, and hence this is what we need to resolve either today, or they have sort of instruments that they get in the business that can help surface value at a later point in time after the funds have made their levels of return, if you may. And then, of course, you have the operational restructuring aspect where I think that's where funds also need to add value. What has happened in the past is not necessarily what should happen in the future. So I think we need to develop a new breed of professionals, or capabilities, or funds can bring in what their global expertises are in various sectors to identify the right management and help run some of these businesses such that value is surfaced over the long term.
So one important fact that you brought out is promoters and their participation in the process. In the past, at least, what we've seen is it's blocked by promoters. Any kind of possible restructuring, other than a financial restructuring, is blocked by promoters. Do you see a change there, and are you comfortable, taking over companies where it might require changing the promoter or completely changing the management? So is that something that you're now comfortable at, or you think you're still far away?
No, I think inherently, there's no way that you can get a transaction done if the promoter is not on site. It's very difficult to. I mean, maybe it's possible, but it's very difficult to run businesses or transact a business until such time as the the motivations or requirements of the promoter are not satisfied, because you never know when it comes back to bite you. So I think we almost think of helping resolve all stakeholder issues, banks, promoters, and existing shareholders, frankly, before we transact, at the time of transaction itself. Maybe you could go to the courts and get hold of the shares, but maybe you face certain other repercussions during operating your businesses going forward, and it's not something that's unheard of. Like we faced that in the past ourselves, but I think it's important, and it's important learning for us and I guess for the general community, that promoters are an integral part of the system. They've run businesses and they've grown them over periods of time. So there's a certain set of emotional attachment to it, and they really do not like someone snatching a business away from them when they've actually built it. So it's important to keep cognizant of that while you're transacting, and ensuring that they are on side in whatever little way they've won that final dealing or debate. I think you need to make them feel that they've won something, and it's important to get them on side while you're transacting.
Okay. So you still believe it's more collaborative that will work rather than a more hostile environment where you sort of take over the control of the company? And
absolutely. I mean, that's how we like to transact. We like to think about investing in businesses rather than going head on with the promoter.
Sure. Sir Prasad, just the other stakeholder here, which is the lenders. There's again in the past been a challenge of lenders being able to come together and sort of settle on the right resolution mechanism. We've had JLFs being formed, but again not much success from that also. So do you see that changing with lenders now coming together? That's a concern that ARCs have also had, that they find it extremely difficult to aggregate debt, and without debt being aggregated, it's difficult for them also to come up with any effective resolution strategies. So do you see that changing?
Yeah, again, I'll answer this in two parts. One is related to the lender's perspective, so far as their behavior in GLF is concerned. I have also experienced a few cases where perhaps we don't have the meeting of minds. The reasons could be many, because maybe in bank A, the account is standard, in bank B, C, D, it's not standard. So there is an issue there. Because provisioning hits the bank which has NPA. So therefore, there is a not meeting point. This issue is going to be tackled in the IBCC. So that is one good step that IBCC will take care of. As I said, once an approval has been given, everybody has to fall in line. We have experiences where a stakeholder of 1.9% is going against the wishes of 98% lenders and filed a case. So this issue is going to be tackled there. IBCC, and I'm hopeful, I'm confident that with this 75% voting rights that they have, once at least 25% will not be able to impact that. About the ARC, again, our experience has been basically on the valuation issue. They feel that the bankers are asking for too much. We feel that they are giving us too less. So that has been the problem. And we have been trying to resolve this. We have been discussing with them because how do we actually value an asset? And as Karthik has pointed out, primarily, thus far, what we have seen is because the management fee is one component, perhaps, pardon me for saying so, because there will be other ARCs representatives here also, directors maybe. If that is done, they get it, their operational costs are met. Other than banks, they are also not doing something which is innovative for resolution. One would have expected, in fact, I had interaction with them and I have been constantly asking and requesting them, okay, boss, you have to have somebody who is proficient in handling financial issues. That perhaps is a call which ARCs will have to take. This is my suggestion to them. Because some of the issues which a banker can appreciate in respect of this resolution of NPAs, perhaps a non-banker, even though a professional, he may be a chartered accountant, cost analysis, finance analyst, whatever. So that is the one call which ARC will have to take. On the valuation side, yes, the challenges are much more because from 1st April 2017, it's going to be a 50-50 basis. But the positive side is the ARCs would now be compelled to go for actual resolution. Find some way, as capital will be in abundance, no issue. Even for ARC, 100% FDI is permitted. Capital will be in abundance. So we can, depending on whether the need for private equity or some financial assistance or some debt component is required in respect of each of these units. So each of this company resolution has to be through different routes. Debt, equity, maybe combination, maybe structured. So, and the fund will not be a problem. So my take is that banks and ARCs can work together on this stream. And that will be beneficial for both of us.
Thank you. Nikhil, you've been a part of a company that now has been looking at stressed assets for a while, both here in India and overseas, and you also intend to have an ARC structure in place. So if you could throw some light on what's your experience been in the country and how that's different from the global perspective, and do you believe that within IBC coming into place, this could change materially if it is not been up to the global standards in the past?
Sure. So maybe just before answering the question, just taking a step back, at the end of the day, the way I think about the world is, and specifically in India, if you want to be growing at 7%, you want businesses that are healthy and have access to capital, and also the cost of capital needs to go down for these businesses to be competitive. And the way to, at the end of the day, attract and diversify the sources of capital is to have legal systems in place where if it's a debt provider, they have contractual rights because they don't have any governance rights. And if it's an equity provider, they have governance rights which they can enforce on. And so providing a system or network as well as infrastructure to be able to do that is ultimately the most critical thing. And over time, as you're able to attract more people, more pools of capital, you not only diversify, but you also reduce your cost of capital. And that, therefore, will lead to these businesses being more competitive, and it's a virtuous cycle. So at the end of the day, I think IBC is a step in the right direction. The way, and we've sort of debated on the panel a little bit, or talked about it, is like the four components as you think about any stress situation that are there is you've got the promoter, you've got the lender, you've got essentially the incumbent or new management team, and then you have a capital provider. What we've seen thus far is promoters have been sort of, can be a roadblock. Again, it's all about the incentives. Their incentives are not aligned. There's not a clear path to aggressively and decisively restructuring the businesses, and therefore they continue to sort of drag along, and in the process they do whatever they do. But with hopefully the new law coming in, it's pretty clear that there's a transfer of management contract from the promoter to the new management team or what have you. Now, that's in theory. We all have to actually do it, and that's where the execution lies. I think when we move to the lender, I think the fact that now you have a finite timeline, as Mr. Prasad was saying, and then the threat of a liquidation at the back end of that is enough incentive again for people to find a solution, and also find a solution which is sustainable, because you don't want to find a solution and end up back in bankruptcy court in another 6 months. So the idea here is pretty clear that you need to do something about it. And once you're, like the clock is ticking, you need to take action. And because in order to take action, you need to think through multiple ways you would restructure. Perhaps you run a process, perhaps you come up with alternative solutions. It's almost like you need to run a process in the market where you get bids on the asset in various shapes, and form. And that is a good price discovery mechanism, which is lacking today. This is again assuming that this system works, the new proposed system. But getting a mechanism for forced price discovery, and then having the judicial system sort of stamp on it to provide the backup for the banks to have taken the decision, in my mind, is going to be absolutely critical for this to succeed. So that then brings you to the third and the fourth pillars, which are management team and capital. I think that's where alternative funds such as ourselves come into play, where we've been doing this. This is a common theme across the globe. Like, businesses are built, they grow, they die, some get restructured, and so on and so forth. It's a cycle. And folks such as ourselves and Karthik, where we have the expertise to help restructure the capital structures and also to provide management bandwidth. Now, it's not appropriate to say all promoters are bad. There are good promoters with businesses who've fallen into bad macro backdrop and therefore underperform. And then there are the other types. And so at the end of the day, figuring out what was the reason, and therefore coming up with a solution, whether it's partnering with the promoter or professionalizing the management team, so that the future of the business will create value, and keeping the incentives for the promoter as well as the lenders in terms of equity participation, so that tomorrow, if you do well and you're able to do what you're saying you will be able to, everyone will benefit. It's a win-win solution. So at the end of the day, what I'm trying to say is the only solution that will work is a win-win for everybody. And the only solution that will work is something that's time-bound, because at the end of the day, the challenges, if you look back, were time to recovery, which then led to the value that was recovered was a lot less. If you compress the time frame, if you aggressively restructure a business, you then can make, again, everyone will benefit in the process. So then going back to sort of like, how do you compare this, the proposed IBC code relative to other places? I think the most relevant contrast, I think this code is similar to UK, Singapore, and what have you. The most contrasting methodology is the US, where you have the debtor in possession, which is essentially the management team continues to run the company, and then you restructure the capital structure. I think when you think about where India is and where a lot of the problems start from, I think the creditor in possession model is the right one. I would also say the way it is being proposed today, the code is very friendly to the creditor, so almost the pendulum has swung way towards the creditor, which may not be a bad thing in the near term, but eventually it'll have to evolve to strike a balance between sort of the creditor and the promoters. So I would say I think it's a fantastic, in concept, it's fantastic. It's amazing how quickly the government was able to sort of think of it, put the plan in place, and start to implement it. Now, having said that, the key challenges on a go-forward basis are going to be really NCLT and IPs, I think, which is ultimately going to be the critical thing. And therefore, developing an infrastructure, getting the right mindset, where I think Avizer was talking about, it's okay to fail, let's restructure and recover, versus let's kick the can down the road. I think that needs to change. And the quality of the IPs is going to be absolutely critical, because a lot of power at the end of the day is being given to those professionals. And if you do not get the right quality, the outcomes will suffer. And therefore, providing the right incentives, picking the right people, rigorously sort of making sure. And I think the last point I'll make here is, as far as IPs are concerned, I think there's this issue around indemnity. They don't know what this means down the line, like tomorrow I take action, who's going to come after me and what have you. So there has to be a way to protect them, protect firms, because a lot of firms are actually thinking twice before sort of backing an investment IP professional or what have you. So getting that in place ultimately is going to determine whether this conceptual thing, which makes a lot of sense, few years down the line will be successful, and therefore help us develop capital markets that are deep, and access to capital for the companies in India is again diversified, and the cost of capital is globally competitive.
Right. Thank you. So one common theme that seems to have come out is that the concept is great. They seem to have thought it through. What's required now is the infrastructure and manpower to be able to implement it effectively. Just one add-on question. In my discussions with banks, the questions related to why they don't sell more to ARCs or stressed asset funds. The common answer seems to be, we will sell once we have exhausted all means, and we are sure that it's no longer recoverable by us. In most cases, that ends up being too long, and post that, ARCs don't seem to be interested in buying their assets. So what do you think is the value that funds or ARCs like yourself bring, and how would you convince the bank management that you can do a better job of the recovery, and it can be a win-win situation for both?
Sure. So first of all, I would echo what Karthik had said earlier. At the end of the day, whether it's an ARC, a fund, they're just means to access to capital and, in some situation, management expertise. And therefore, we've applied for an ARC license. We have a fund which invests globally, and so it doesn't really matter what way, shape, or form that exists. Now, historically, banks were more comfortable dealing with ARC, but hopefully with this new code, there is no differentiation between an ARC or a fund. Now, where the ARCs could be beneficial is totally different, is around like the trust structure, the tax implications, and what have you. But that's not relevant here. I think at the end of the day, the ARC needs to do more of the R than the rest of it, and I think that's where the value creation will happen. And so whether it's a fund or an ARC, as long as you have the management expertise and you can turn it around, it'll happen. Now, answering your question around like how does the value discovery happen, I think that's where the point I was making earlier. You need to have a time process with almost a threat of liquidation where everyone will lose significantly. So therefore, you now need to find a solution. And solutions are asset sale, restructuring the current asset, management change, what have you. And you have to decide within 180 days or 270 days. I think the way to make it a win-win for everybody, our view is that obviously the lenders will have a write-down. At least the way we think is to have some equity stake in the restructured company, both for the banks as well as the promoters, is very important, because that aligns all of the incentives. And it also provides some kind of insurance that tomorrow, if it's like a massive success, you're going to participate, and maybe you'll recover all of the debt, which to start with, if you continue down the road that you would not even recover a fraction of that. So I think it's just the balancing act, and at the end of the day, each party has their return hurdle, and you hit that, you put in the effort, and you share the spoils on a go-forward basis.
Okay, great, thanks. So, Prasad, one sort of concept that we've been hearing for a long time, but it doesn't seem to be coming to implementation is bad bank or national ARC or different names that it keeps coming up with. What are your views on having an entity of that nature set up, and you think that's something which can work for the financial sector?
In this project, in fact, not much has been said about this, but there is a chapter, I think, written by perhaps Chief Economic Advisor, Mr. Subramaniam, and his colleagues.
Right.
They have talked about this public sector asset reconstruction agency, PARA.
Right.
Yes, you have a case, but you still have a long way to go. This is my sense on that, because what the structure is going to be is like a centralized structure which is expected to buy all the debts of this banks. And now, since it is public sector, it seems to be maybe initially from the public sector banks only. But again, the problem is not there, whether it is centralized system of, bad bank or a decentralized system of bad bank. For example, in our organization, we have a setup which is responsible for handling the assets which can go to the bad bank if it in a centralized scenario. The problem really is, even if it is a centralized scenario, where are you going to get the capitals from? One. Secondly, yes, you can have, maybe, is the government going to provide you capital? I don't know. Perhaps they are too much stressed, even though there's a lot of talk about consolidation and the fiscal deficit and all these things. There's an issue there. If you look at recapitalization, it's about the fund for this year for the banks, it's just about 10,000 crores. Right. Although the FM has said that if more is required, we'll fund them. So there's a limitation there so far as the government is concerned. Then you have the capital market. Unless somebody has tested, and having seen how the challenges have been and what challenges has been, perhaps there will be some reluctance on the part of the capital market also to contribute, to participate in this PARA agency. Third is, when you look at the global investors, my sense is that they are looking at returns ranging from maybe 16, 20, 25% even. Sometimes, yes, but initially, perhaps they may be required to take a call that perhaps in the next 2-3 years, when they actually buy those assets, the return has to be certainly muted one. Maybe you can have maybe 8 to 10%, perhaps some more time from breaking even for a particular fund. So these are the calls which have to be taken so far as the capital side is concerned. Now, about the administrative structures, we do not know. We do not know. So as of now, to me, as it seems, it could be a medium-term, administrative structure. Conceptually, well, good, but then again, it's a lot of questions to answer.
Okay. Thank you. Karthik, just to take that further, you would have, there are other places in the world who have seen this kind of a structure. Do you believe that's one way in which we can go, looking at a more national sort of a ARC rather than private ARCs and multiple private ARCs, and which do you believe would be better than the other? And the other point that Prasad brought out, which was on the expected returns of 20-25%, and even if that is possible, you need a very long horizon. So what are your thoughts on that aspect?
Sure. Again, I just come back to a few points made earlier, on the first question.
Mm-hmm.
I think the intent, like the ARC is just a capital provider, as long as you have the ecosystem of the right sets of professionals and, to operationally turn around businesses and the right mindsets to, restructure loans upfront to, figure out what are sustainable levels for the business. I think, we're kind of neutral whether it's a national ARC or, a bunch of smaller ARCs. It may be easier if there are smaller ARCs because there'll be lesser number of stakeholders and they can manage it themselves.
Sure.
In terms of, return expectations, I mean, that's, end of the day, I mean, we've got to recognize that, all of these pools of capital, I mean, these are high-risk pools of capital, right? I mean, they're akin to equity and they got the restructuring component as well. So these will come at a price, right? And, infrastructure assets today itself, I mean, first of all, I mean, like debt is being made at like, 8, 9, 10%. And, infrastructure returns are like, 12, 13, 14, 15, whatever you think of it as. So, I mean, like any of these restructuring situations will involve like, higher cost of capital.
Sure.
That's something that, again, the system needs to get sensitized about because this is the first time that, it's sprung up. The stressed assets issue has sprung up and, it's having to involve stakeholders who are not necessarily used to, having seen these situations in the past. But yes, I mean, I, completely agree with Mr. Prasad, to the extent, you can get cheaper cost of capital, and investors are willing to, fund businesses such as this, which, at cheaper cost of capital, maybe you can pull it off. But, generally my sense is it would be, it's a riskier business, it's a riskier proposition, so it will come with its, fair share of us as well.
Sure. Thank you so much, everybody. We've sort of discussed what we started out with, what Mr. Prasad said at the beginning, which is what could have led to it, a bit of prudence in lending, the expectation from promoters. I hope there is enough learning that all the constituents have had for going forward. Important thing that came out in the discussion is everybody, all the constituents now agree that the new bankruptcy code at least takes care of a lot of these issues that we've had. A collaborative process is possible. Promoters can win in this process. Banks can get the right amount of return, and there is hopefully enough return to the third parties, the stressed asset players. So it can be a win-win situation for everyone, and hopefully the operational aspects and the implementation aspects of the code can be taken care of, and we would see a scenario where stressed assets is not going to be something that will be a topic of discussion, but only the 7 or 8% growth and maybe higher. So with that, we come to an end of this session. Thank you all.
Thank you. Thank you.
Yes, we'll move to the Q&A session.
I think the right size of the debt is available now, where you want to invest. Okay? So there are assets where 40,000-50,000 crore is there. There are assets where 5,000 crore upwards is there. So what do you think that why the deals are not still happening? While the stress is all around, all lenders are under, pressure to find solution. So why the deals are not, happening?
I think at the end of the day, it's a price discovery exercise where for transactions, there are a lot of situations, as we said, for transactions to happen, there has to be a price discovery mechanism, and over time, a lot of the funds, such as ourselves, will assign a certain sort of haircut associated with that. And once, the pricing mechanism tells you this is the haircut and this is what it'll take, this is the capital infusion that is required, then the banks will have to go ahead and take it. And I think today the construct of and these are in some situations steep haircuts and in others not so steep, but I think it all boils down to, do the bankers feel comfortable, do they have the right backing, and then once they have the backing, again, being able to make the decisions in terms of what structures they're going to end up with. So the example we were giving earlier, if they get part of equity, and they're able to value those equity from an accounting standpoint, equivalent to what the capital is being provided for, I think there will be more transactions. So I think we all need to be patient. Now, we can be infinitely patient, but a little bit more, and hopefully with this new code, that timeline gets compressed where a decision needs to be made during a certain period of time, and that hopefully will bring all the pieces together for transactions to happen. I don't know, Karthik.
Yeah, I agree with Nikhil. It's more about the price discovery in a finite time frame, which forces existing stakeholders to come to a solution, which can at least, catalyze, transactions to happen. We're probably at the start of it. Give it some time, and maybe we will see a few transactions. The other view, of course, is India is not an easy operating environment, right? And I sort of stress on it, time and again, but it's not an easy operating environment. Running a business here is not running a similar business elsewhere, in the West. So I think, being cognizant of, what we can actually bake in as, a recovery scenario, by having changed management or, being able to effect operational improvements is something that will take some more time for, funds such as ours, to get comfortable with. We have, in the past, on real estate and infrastructure, done this, and have, affected, improvements in the business, but it's not necessarily the same as, what you may have envisioned at the time of underwriting, right? So I think it's a function of, having been in the system, experienced it, and then being able to underwrite it better. I think, the levels of, operational improvement or, positivity that, the banks or the promoters, especially the existing promoters, may see is not necessarily the same view that we may share. So, even that divergence, sometimes results in us having to price it at a certain level versus, what the expectations are. So I think effectively it boils down to, what pricing is, mix of, haircuts that banks may need to take, terming out a debt or like issuance of equity securities, as also, views on, operating improvements that we think we'll be able to effect over a period of time. Hopefully, after having spent, more time on the ground here in India, we'll be able to price that in better.
My question to Prasad. One good point you mentioned, ARC and banks together. If together we work, we can resolve a lot of issues. Now, my question to you is, in working together, what I would think, bankers should retain the working capital, and the rest of the loan you transfer to an ARC. We work together, so that the revival would be much faster because company has the working capital. Why we are not trying this? And SBI as the leader should take the lead in this.
Since you have raised this question, Mr. Anthony, in fact, when we sell the assets, we do not make a distinction between working capital or a term loan, because the company is indebted and the assets are created out of the bank finance on current assets and the fixed assets. So the problem for the bankers generally is that we do not extend. Normally, when it comes to such a stage, when we are actually thinking in terms of selling it to ARC, at that point of time, extension of additional funding is not considered. Therefore, we take a call on selling it as a composite, not, comprehensive, wholesome, not some sort of a composite that part of it will go, part of it will not go. Second point is that as we have, almost every bank may be having the same structure, the life cycle of any company, there are chances that after implementation of, say, S4A or SDR, things can go, the company can improve. There is increase in valuation. So those cases, we don't even think of selling those to ARCs. Only there are the cases which perhaps the lender have decided that there is, 99% it is gone. So what do you fall back upon? It's a security. And in almost all these cases, the security varies from 5%, 7%, 6%. And as ARC, pardon me for saying so, as ARCs, again, as I suggested, perhaps, again, your problem would be you are also with only 5 to 6% of security. Since I was not able to extend any financial assistance to the company, had you, with the capital coming in, and through various structures, whether it is debt or equity or maybe non-fund facilities, perhaps if it can be saved, that will add value to you, and that can be transferred through the redemption of SRs. So this is how we look at that. And instead of simply, doing the way that we have been doing, because you are the last stage. When we sell the assets to you, it is a gone case for me. But we sell the asset to you because with a lot of hope that things will start improving. But if you still do the same thing which we have been doing, then that perhaps, in my view, that is the problem that I foresee.
Hello. I just want to, I heard that, the problem of, transferring or selling the assets to ARC is that, the valuation, that's a challenge. Now for that, I have a structure, what happens, if the assets have to be transferred at the security value, as Mr. Devendra Prasad said, in that situation, even the bank can do that, they can sell the security and recover 5 or 6, 7% out of 100%, whatever. what is the role of an ARC? In fact, it is a half-hearted thing that we have done in this country. Now we are talking a bad bank. The real thing is that, bad bank should be, the real, agency, which can resolve the problem of, stress assets, where, they have to involve their own capital, they have to have the expertise of turning around the companies, and then, recovering the money for themselves as well as for the bank. So I have a suggestion, for valuation, it should be, whenever any asset is to be sold to ARC, it should be, there are two ways of, doing it. One is enterprise value, one is a security value. Enterprise value, you never know, when asset is bad, whether the promoter will be able to run at that value or not, you can never be sure. So in that situation, it has to be the security value plus something, which has to be added into that, so that, the ARC has to take its own, risk also on that asset. Then only they can resolve and recover their money. So that is what, I feel. And then for bad bank, I would suggest the ARCs can be converted into bad banks. There's no need of, bringing another institution, in the system. The ARCs, they have to be, asked to bring more capital, and then, we have to be, they have to think about, that what should be the role of, the bad banks. That, as we have said, as we have seen, ARCs, though they are called asset resolution company, but they are not doing any resolution, they are managing. And as somebody mentioned that, the management fees that they get, it is enough to run their operation, they are running. Thank you.
So one of the changes that happened in the guidelines of ARC some time back was that the assets that are bought, ESRs, have to be rated, and based on the rating, there is a value that's assigned, and that's the value that they have to use, both the banks and the ARCs. That is dependent a lot on what you're saying, the security and expected cash flows and the value from that. And the management fee has also got linked to that value, and the kind of provisions that banks have to do has also got linked to that value. So the only difference is that doesn't happen upfront when the assets are sold. That happens it has to happen within 6 months of the sale. So the initial valuation is not based on that, but the ultimate value that the bank or the ARC derives from it is based on exactly what you're talking about.
Hello? Yeah, each and every ARC proposal from the banking side, do you need to get an approval from the government nominee directors, each and every proposal, or sometime in the absence of that, the banks can also take the decision, or you need?
Me?
Yeah, I'm asking you as a banker. Yeah.
Up to now.
Yeah.
Up to now, no. We don't have to seek approval from the government nominee. It's not that. But we are required to follow a policy. And that has to be approved by the board, where the government nominee is there. From 1st April 2017, recent RBI guidelines on sale to ARCs have come, and as we are also going to implement that. What they have now said that you identify those assets which you intend to sell during a particular year, make the information available so that anybody who is interested in buying those assets can approach you for buyout. So that policy is going to be implemented with effect from 1st of April 2017.
Okay.
But not necessarily in each and every case. Now, once this board-approved policy is in place, so everybody will be aware, it's a more transparent manner. Okay, so SBI would be going to sell, say, 100 assets during the current year, say, 16-17.
Okay, so the time-taking process is not, they're getting into the North Block and etc.
Yeah, no, nothing. Even earlier,
Okay.
there was no question of North Block, seeking consent or anything. Nothing.
Okay, thank you so much.
We have the time for one last question, if any. Great. So with this, we conclude this session. Once again, thank you.
Thank you.
Thank you very much, gentlemen. If you could stay on stage, please. That was quite an enlightening panel discussion. I request Mr. Mahendra Menezes, Project Director, ETH, to kindly come up on the dais and present each of the members of the panel with a memento as a token of our appreciation. Once again, thank you, gentlemen, and thank you, Mahendra, for doing the honors. We will now break for tea and coffee. Kindly restrict your break to 10 minutes so that we can reconvene and commence proceedings post-tea at 12 sharp. Thank you very much.
This is the clicker, sir. This is already uploaded. Yeah. So when you will be on stage, this will come on screen. Okay. This is the one where you can forward it. If you want to go back, this. Just press once only. Okay. Please take it till. Yeah, I think I know. Next जो presentation है ना podium से. Next presentation. Everything is okay. And whatever will be going on over here will be listed there. In there also, right? Okay.
Can you give me? I want to move around after the first one slide, one or two slides. प्रॉब्लम है
ऑफ करना है
हाँ
पोडियम ऑफ कर देंगे ना उधर से आप इस पे बात करें तो पोडियम
या ठीक है वो भी ठीक है How are you?
good to see you eagerly waiting for your presentation
Oh.
so do you think this new rule from 1st April 2017 that so आपका presentation है
But it should have been implemented by banks. Off कर दिया है
हाँ अभी ऑफ कर दिया है आपका प्रेजेंटेशन है ना सर ये यूज करने का ये नेक्स्ट प्रीव्यू स्लाइड चेंज है ओके
no already they are so fussy about pricing and valuation SBI guy
Okay.
Ladies and gentlemen, I request you to kindly settle down. If you have your tea and coffee mugs with you, kindly get them into the conference room, into the ballroom rather, so that we can commence proceedings. I repeat, I request all of you to kindly settle down in the ballroom so that we can commence proceedings. If you have your tea and coffee mugs with you and have not finished your tea, kindly get them into the ballroom with you. Thank you. Ladies and gentlemen, I request you to kindly take your seats so that we can proceed with the post-tea session. Thank you. I'd once again like to remind you that you can tweet about the summit using the hashtag ET Remodel in India, please feel free to do so. I'd also like to take this opportunity to thank our partners for this event, presenting partner Edelweiss, associate partners State Bank of India and Trilegal, live webcast partner 24 Frames Digital. Gentlemen, kindly take your seats so that we can commence proceedings. Kindly note that feedback forms have been placed on the tables. For each of you, you are requested to kindly fill in the feedback form in full. We will have a lucky draw at the end of the summit, and there could be 2 lucky winners. So kindly fill in your feedback forms in full, and we will have 2 winners that will be pulled out at the end of the summit. Thank you very much. It is my pleasure now to invite on the desk Mr. Sibi Anthony, MD and CEO, Edelweiss ARC, for his presentation titled Reality Check, the Business Cases of Bad Debts Recovery through ARCs. Thank you for the warm round of applause. Kindly greet him with another round of applause. At the end of his presentation, we will have a 10-minute session for questions and answers, so kindly reserve and hold your questions till then. Welcome, sir.
Thank you. Good afternoon. The Remodel India is a good theme. In fact, last 2 years, Economic Times has been running this. I want to discuss about 15 to 20 minutes on what is the role of ARC in the Remodel India. Ideally, ARC's position should have been at the prime. But unfortunately, ARCs as an infrastructure, as an institution, as Mr. Rajat also mentioned, it has not performed well as of now. It's only a perception, or is it a reality? We need to check that. Why ARCs has not caught the attention or imagination of our policymakers? Why ARCs are not bad banks? Why they can't be converted into bad banks? All these things we need to discuss. In fact, what are bad banks? Time and again this issue comes up. There was some discussion on bad banks in the earlier panel. I think very little is known. What's a bad bank and what it can do, whether it's a good idea to have that in the public sector. I don't know how many of you know that I was heading the first bad bank in the country, in a public sector bank. Bad bank, globally, if you really look at globally, bad banks are institutional instrumentalities for a short time, 5 to 7 years. They are created for one specific purpose and wound down over a period of time. In Indian condition, public sector is the right for. The recent example, if you have gone through the reports that have come out, the recent example was 3 bad banks set up in the Europe. One was Irish, which is named as NAMA, National Asset Management Agency. Second one was SAREB, which is Spain. And third is, I think, FMS in Germany. These were set up during the period 2010 to 12, post the world economic crisis. What has been the performance? In fact, all these were, again, funded or guaranteed by the state governments. Fortunately, Spain and Ireland, they could transfer the asset at discount of more than 50%, somewhere around 55%. The assets were transferred to these AMCs. Germany, which was again in the public sector, transferred the assets as 100%. And I think the time period for their winding down is it's coming up. And the performance, I think Spain and Ireland have nearly recovered the transfer price in 7 years, I think around 6 to 7 years now. What has helped Spain and Ireland is mainly the assets transferred were all real estate assets. In fact, real estate loans were transferred in Ireland and Spain. And during the last 3-4 years, prices of real estates have really gone up and they could recover some. Whereas in Germany, it was a specific asset, specific group's assets. I think a group which was involved in exports, which went almost bankrupt, government nationalized it and transferred to an ARC, an asset management company. There, I think even after 7 years, I think recovery is hardly 40-45%. This all shows what is the value at which the assets are transferred to a bad bank. I headed the SASF of IDBI, which is known as the first bad bank of India. Assets were transferred at 70% of the original loan value, whereas the asset would have been worth at that point of time must be around 25 cents to dollar. Why I say 25 cents per dollar? Because as soon as I took over that particular institution, I got offers from 2 international funds, stressed asset funds, even at that point of time it was there. They both valued it in the range of 25 to 30 cents per dollar. But there was no structure under which I could sell that because it was a Government of India trust, and though I took a paper, I was not successful in doing that. So it's going on. I think as of now, we have recovered around 5,000 crore out of around 9,000 crore. It started in 2004. We are in 12th or 13th year now. So bad bank, today I was listening to Mr. Sudhir Kotak, who was mentioning bad bank is a good idea provided it is thought through in detail. Yes, if it is thought through in detail, it's a good idea. According to me, bad bank is a bad idea in the public sector. Actually, ARCs are doing a great job in that direction. I think ARCs should be encouraged to do. And in my presentation, I want to talk about what ARCs have done. Because very little knowledge is available in the public domain about ARCs. What are ARCs and what they are doing? What is their role in the NPA management? All these things I want to discuss. If you really look at ARC industry has reached 13 years. So we are in the teens now. During this 13 years, the industry has evolved quite a lot. Industry has evolved hugely. In fact, there were 3 phases in the ARC industry in this short span of 13 years. It was conceived originally as an agent of a bank, purely as an agent of the bank. Initially, it was 0-100 because ARC didn't have a skin in the game at all. Somewhere in 2006, it was made 5.95. 5% also was a very thin, small skin in the game, actually. It's primarily the role of an ARC until 2013. It was an agent. It was an agent, as Mr. Prasad also mentioned. The banks transfer these assets as a last resort of recovery. Because it's an agent after all. You give a management fee, you hold the asset for some time, try to recover whatever possible. So if you really look at the performance of an ARC should be judged from that context. Even in that context, I would say the performance of ARCs have been exemplary actually. Why? Because as per World Bank report, the recovery in India, Indian context, recovery by any other method, whether it is DRT, court route, BIFR, whatever you talk, it has been estimated around 25 to 26%. And as per an RBI report, the redemption of SR by ARCs, historical, I'm talking of historical figures, it was 50%. So look at against 25% in the other modes of recovery, its ARCs could do at 50%. Now, what was the second phase of ARC in its lifespan? That was when Mr. Raghuram Rajan took over RBI. Perhaps he is one governor who knew about this, who thought about it, and he said, yes, the infrastructure created in the name of ARC is great. We should reactivate it. And he nudged the banks, told them that you should transfer fresh NPAs to the ARC so that they could try to revive them. Only junk assets, if it is sold, I think they can act only as an agent till the assets. That used to be a warehousing approach. Earlier, the ARCs were a warehousing of all bad assets. But 2013, at least new assets started coming into ARC space. But suddenly, of course, again I am saying Dr. Rajan was a thinking governor. So he felt again that 5% skin in the game by ARC, it's not good enough. It continues to be a management fee-driven business. It should not be, ideally so. And he changed it to 1585. To my mind, 1585 is a very good structure given the capital scarcity of the banks. It's a very good structure. And 1585 it's a paradigm shift actually from 5% to 15%. ARCs were conceived as agents, so there was no capital. In one ARC could be set up with 2 crore of capital even today as per RBI regulations. I mean, there is no capital. There was no capital was intended to be raised by the ARCs till that time. So 1585, the industry shifted to a capital-intensive industry. It is really a capital-intensive industry if you really want to do business. If you are a serious player, you have to do that. And look at the shift that has taken place. As a management or an agent of a bank, they used to handle only junk assets. In a 1585, when I put 15% of my capital, I need to get my return of not great. We are talking of 18 to 20, 22% IRR. And if I have to get that, I need to work hard. I need to work hard because the so-called management fee, because there was a perception that all the ARCs are, management fee driven. They are carrying on the business of management fee driven. It's not. Now, if I have to earn 18 to 20% of on my capital, I need to work hard because the management fee of 2% will give me an IRR of 8%, whereas my cost of capital is nearly 15%. So the business has shifted. It has changed to a different level. So in a 1585 structure, you need to acquire only operating assets, potentially good businesses, and asset rich. If a business is not there, it should be asset rich like real estate. This is the shift that has taken place. But then it has become capital intensive. But has the government and RBI did anything for helping ARCs to raise capital? No. So again, we approached Dr. Rajan. I take Rajan's name because he was the most receptive man who thought about the industry, who brought about a lot of reforms in the industry. In fact, there was a lot of constraints on the ARCs. SARFAESI Act was so restrictive, you just can't do much of fundraising in that. The 50% restriction on the promoter, main promoter, that was a huge constraint, which we got it removed in the SARFAESI Amendment Act. It happened about 4 or 5 months back. Post that, in fact, we ourselves have raised From 100 crore to we have gone up to more than 500 crore. So, so the industry is changing. Industry is changing, and ARCs, if they are serious players, they can do good number of good businesses. The so-called pricing mismatch, somehow I am not in that school of thought where there is a pricing mismatch. If the asset is good, there is no issue of price according to me. We have acquired assets even at 100%. 100% of the loan value we have acquired assets. Even we have given price above 100% because as on the date of transfer, some interest would have been accrued. We have taken that. It makes business sense even if you buy at that price. So I don't think there is a pricing mismatch. Pricing mismatch is there if there's a lot of risk in the business involved. If the business inherently, if the business is robust, I think there's no pricing mismatch. But there are challenges. Challenges continue to be there. One great challenge, according to me, is that aggregation in the ARC's hands. Because even today, banks don't sell in consortium. If we have to turn around these companies at the fastest pace, we need total debt aggregation in our hands. It's not happened because after acquiring the first debt, next 15 months is a crucial period. It's a crucial period in the life of that particular asset. We lose that period by trying to acquire that, all these debt. Unless you have 100% debt, I mean, it's going to be very difficult. With some of the examples I want to come there. Second is the revival capital or the capex and small working capital that is required. Because working capital continues to be a huge issue for revival. That's what, in fact, my suggestion to Mr. Prasad was that ARC and banks should work together. As an ARC, I have constraints in giving non-fund based limits. I can, to a certain extent, I can give fund based limits. But non-fund based has to be given by only banks. We need to work out a system. We have been discussing with the banks. We have been discussing with the Reserve Bank on this. Hopefully, I think at some point of time, some solution will come. My sincere suggestion is that banks and ARCs should work together. Banks should retain the working capital with them, which should continue to be standard in their books. And unsustainable or part of sustainable debts, term debt should be transferred to an ARC. And we both should work together for the early revival of these companies. Regulatorily, this is a small issue. If any Reserve Bank representative is here, or I would suggest Economic Times to highlight this, is the capital adequacy issue. Because today we are the only ARC which has done so much of business. Because at times we find this capital adequacy, what is the regulatorily 15%, comes in the way at times. I think we have highlighted this to even Reserve Bank because in the capital adequacy of 15% for NBFC or even for banks, there is a tier 2 and all other structures are given. Whereas in an ARC structure, I think they are asking capital adequacy only on the own capital, which becomes slightly difficult when you ramp up the business. It could hamper your business at some point of time. But despite what I want to say, despite all these, ARC has done well. SR redemption 50% is very good. But going forward, this 50%, as I said, it is again historical. In the 1585 structure where we acquire today, unless I recover 150 to 160%, I don't make my return. So I would think going forward, wherever under this structure acquisitions have been done, SR redemption would be more than 100%. Should be 110 to 120%. That's what is my estimate. If that doesn't happen, then ARC itself will find it difficult to survive. But I think that's not an issue according to us, because the type of assets. Finally, even the, the asset revival is dictated by the type of assets. And of course, the macroeconomic environment. We hope the macroeconomic environment will improve. As Prasad was mentioning, I think even the NPA started stabilizing. And I feel even astrologically, I think 7 years is the Shani Dasha, I think. Shani is for 7 years. I think we are now 7th year. I think 2017 should be a good year for all of us. I hope it should be. But at the same time, we are aware, as an ARC, which is a responsible ARC, we know what has brought us here will not take us there. So you need to develop more skill set if you want to reach there. If you want to get this 160% recovery, I think we need to develop much more skill set than what is there in the system. What are the strengths, the skill set we trying to develop? This is our experience. What we have done in the 595 as a warehousing approach. In fact, even 595, our approach has never been warehousing. Our approach has been always a factory approach. Our organization works like a factory. It goes on. It's a factory approach. But we need to develop many more skills if we have to reach there. First, the debt aggregation, as I said, and restructuring skills. This has been there. Restructuring and resolution has been our core strength, which continues to be there and is getting upgraded time and again. Priority lending, priority funding, and project implementation. This is what we have to develop now. This, along with turnaround capability, I think we are in the process of setting up a turnaround vertical, which started performing. In fact, we have a good team. I think one Sumant is there and Pranjali is somewhere here. So we are setting up a good vertical in that direction. That we feel is a great value addition to our business. Active monitoring and mentoring, of course. In the Indian context, this is what we need to develop. Because Indian promoters and management are the same. That's what our experience, and it's really so. So we need to mentor the promoter, because as of now, we are not in the process of a hostile takeover and change of management. We work with the existing manager. So we need to mentor them a lot to carry on the business along with them. Strategic partnerships. Liquidation, of course, is a end result. If nothing happens, that's where we have to go. And sourcing strategy, so strategic partnership. This has been one of our strengths, and we have been working well in this direction. So I want to take you through a few case studies we have done, capitalizing many of our strengths. Actually, the amount of work we have done, the revivals that have taken place are huge. Just give you a context. We have nearly 31,000 crore of AUM today. 69% of this is revivable, restructurable assets. So balance 31% only we need to deal with either liquidation or settlement and things like that. Now, a lot of work has been done in the restructuring space. I am not taking many of those cases. But coming to a few cases where some of our core strengths, which all strengths we are creating or developing, are being utilized. This particular project was an incomplete mall project in Bangalore. In fact, we worked initially with the State Bank of India how to manage this. We tried to sell this to somebody who can buy it. A lot of them we tried, but somehow we got a maximum of around 250. Maybe maximum it could have been stretched to 300 crore. That's what the value we got. But then we thought that's not the way we have to go. We have to fund them to complete the project and add value to that. That's what we have done. We gave them additional 70 crore. In fact, by the time SBI asset was acquired by another ARC, so we both the ARCs put together, we worked and we both have funded the company proportionately. Now the project is complete today. And I think 85% of the mall space is already leased out. They should be operational by 1st of March, if it goes, everything goes right. Now we have got an offer from 2 or 3 people giving us 500 to 550 crores. I mean, it's a great value addition. This is what we thought, this is what an ARC or the asset management company we should be aiming at. And this has encouraged us to do more in this direction. And we are going towards that. We also, as I mentioned, we have a turnaround capability. We have a port companies in the south, which has nearly 2,000 crore of loan in the banking system. We have acquired at 2,000 crore. In fact, the same 100% debt, plus some, even some of the interest also we have funded. So we have acquired this 100%. We tried to induct a strategic investor here. Somehow, some technical reasons it could not be done. So now what we have decided is we will run our own. We will put our own turnaround management team there. And we have recently board constitution we have changed. And our ENY, we have employed them to be there at the site for fund cash monitoring. With all these, the EBITDA, which was around 110 crore, now we are at around 180, 190, 200 crore. It's progressing very well. Now in the next, maybe in a couple of months, we should be putting in the restructuring plan, additional funding for the mechanization and things like that. So we are actively getting involved in these cases. Why I am mentioning this, because these are the cases we have not so far projected to anybody. Many of them are listed companies, so we have our own constraints on that. Similar was another port project, basically a stevedoring company in Orissa. We funded, why we funded this? Because Gopalpur port was affected by a cyclone, completely damaged. Nearly 800 families were almost on the street. So this we have funded, and today the port is operational. In fact, when my representative visited, a lot of people came there and they congratulated us that such a great thing is done. Jobs of 800 people are back. So it's a sort of, it gives a lot of, satisfaction to you also when you see such revivals happen. Now we have finally, I think Shapurji is coming as 51% equity holder in this. So we expect this port will do very well in future. I think Shapurji has agreed to put in some additional capital as well. Logistic company is an out-of-box solution. It's also a project before time with a huge debt that is totally unsustainable. And even after acquiring, we were finding it difficult what solution it can have, very difficult. But fortunately, we could bring in an international real estate institution. So it's it's very interesting actually. There are about 6 warehouses today that will be sold. Then another 6 will be constructed with his funds. Then it will be sold. It's a very interesting concept we have brought about. I think this is on its revival path now. I think these are all and performance is improving very well. Project Furnace is very interesting case, which I want my banking friends also to understand. In fact, we have acquired only 43% of the debt in this company, only 43%. And they had a debt of nearly 3,000 crore at that point of time. After acquisition, in fact, I've not been successful in aggregating the balance, because I had at least 3 or 4 joint lenders meeting, where the joint lenders forum discussed only about how crooked is the promoter, what all he has done and things like that, total negativity. So I called off joint lenders meeting. We said we will help this company to revive. As a jolt in between, I received a letter from Reserve Bank of India saying that this company should be treated on the red flag. I wrote back saying that if we put a red flag, the company is showing signs of revival. I explained some background on which the negativism comes from some of the banks. I wrote to Reserve Bank saying that I'm not inclined to do this. In fact, on the contrary, I requested Reserve Bank, please advise other banks to sell the asset to us. In a year's time, we will revive this company. In fact, the Reserve Bank replied to me saying that, no, we cannot, as a rule, we cannot advise anybody, but you go ahead. Effectively, that was the reply. So, in fact, this is a company which manufactures capital goods for steel industry, and they have forward integration, steel making they have gone into. That's where they came into the problem. Today, the company is doing so well. In fact, just to give an indication, when I acquired the first loan of this company, the share was around 17 rupees. Share price was 17 rupees. And today, I think it is around 275, somewhere around that, maybe around that. In the restructuring, we have around 10% equity in this. For the sake of these 43% banks, we will be holding that equity on behalf of them. Neptune is the most appropriate solution what we have given. Actually, this is a real estate, and it used to be a mall in Mulund. After we acquired, very interesting actually, after we acquired, we found that the bank had no security. The bank had the security of only the constructed area. They didn't have security on the land on which the building was standing. So initially our strategy was to pull down the building and go for residential project. When we found there will be issues once we go pull down the building, I think then we discussed with the bank also. We told them, you don't have a security at all. If I pull down the building, security is gone. So we decided not to do that. Then after a lot of research and the survey, we thought it could be converted into small offices. I think finally that is what we have done, and there is huge demand for small offices there. And I think we are almost coming out of this now. We should be exiting this soon. I will end by saying this particular case, which everyone knows, it's the Bharati Shipyard. This is a huge asset we have acquired. We need to overcome many more challenges, lot of challenges. In the revival space, it's a huge task to revive any company in India. If it happens to be big. I would think that Bharati Shipyard was such a company that when they sensed there was problem, they went to CDR. They went to CDR maybe at around 3,000 crore of debt. But after 2.5, 3 years in CDR, I think the CDR failed and they came out with a debt of 8,000 crore. Because most of the LCs, BGs all devolved and funded debt became 8,000 crore. And the banks were very practical in that. In fact, the SBI bank led by SBI, this was one of the first consortium sales happened in the ARC. State Bank of India did a 70% haircut and sold it at 30%. So we thought it's a great opportunity to revive this company. We are still very sincere that it will come out. We funded additional money for reviving this company. In fact, after our acquisition, we have delivered 3 ships to the Coast Guard and the Navy. But unfortunately, what happens now, in all these cases, there are a huge number of unsecured creditors, vendors, income tax, statutory authorities. As Prasad, I was happy when Prasad said that banks are willing to take haircut, but even agencies, government agencies are not willing to recognize these issues. That's unfortunate. In fact, here, when the problem came so much, in fact, the company went into liquidation actually because Bombay Company Court gave a verdict that it should be wound up. Then we sat with those winding up creditors and said, okay, we'll pay you over a period of 15 months. And in fact, we have been paying them. And we decided to stop any further unsecured lenders to come in. We thought we will take this to BIFR. We ourselves worked for taking this to BIFR. I'm just telling this in these 4 walls because we knew for sure shipping industry was outside the purview of BIFR. But though it is a shipping industry, they had a lot of other activities of fabrication and there are workers which were not working on ship. So we made out really a case for covering this under BIFR. It was accepted initially. But surprisingly, when we acquired from SBI sold it on consortium, 60% of the lenders gave the loan to us, but 40% remained outside. Over a period of 15, 18 months, we could do another 20, 23%. Today, we are 83%. Now, we need to hold meetings because we gave 30 crores priority funding this company. So we wanted priority on those additional loan, which was objected to by the other banks standing outside. When we took this to BIFR, in fact, one of the bank objected it being brought under BIFR. Then I met the chairman of that bank. I told him, sir, this is with good intention we are going to BIFR. He was not aware. Surprisingly, he was not aware that such a stand was taken by a bank. Anyway, what all said, and I'm saying the challenges we face, lot of challenges. In fact, income tax. Imagine, I said 3 ships we have delivered. We have to get even today 15 crore from Coast Guard. Income tax department has returned to Ministry of Defense that this company owes us so much of money, so any disbursement of this company should be sent to us. Despite this was being in BIFR. It was in BIFR at that point of time. But the Ministry of Defense, I think 60 or 70 lakh we lost like that. So now we are not raising any further bills. We thought IBC is the best thing, insolvency is the best thing, it's a judicial process. We will try to do that there. So what I mean is the challenges in the revival is a huge. If it is only asset stripping and selling, it could be much easier. You warehouse then you will not be acquiring good assets. You will not be acquiring assets at 100%. So, I mean, these are the challenges. Hopefully, things are changing. I think this is my last presentation, and as I mentioned, 2010 to 16, 7 years is over. I think perhaps this was one of the longest phase in the bad assets. That's how we are at 9 to 10% of the NPA. Hopefully 7-year dasha is over. I think we should be doing well. And I'm prepared to take any questions from you. Thank you.
Thank you very much. It was a very nice talk. But one question, that, whether the ARC should be converted into bad bank, that you have not touched. Can you say, mention your views on that?
Yeah, in fact, there was, somebody asked me, if suppose the bad banks come, what will happen to ARC? What will happen to ARC after, the September 1 circular of RBI, when 50-50 or 90-10 comes, who will sell, which ARC will buy? And as per the, again, September 1 circular, bad assets selling need not be confined to ARCs, it can be sold to anybody. Are they not the challenges? Yes. In fact, they are all challenges. In fact, bad bank. As I mentioned, bad bank, ARCs are nothing but bad banks. And I, for one, always firmly believe that private capital should come into this industry in this phase, not public money. Public money and then public sector ARC will be a huge flop. Why I'm saying this? Because a resolution in a distressed asset, there cannot be a straitjacket solution. It has to be a flexible, very flexible policy. Here, we know some empathy shown to some failing business of airline. The bank people are behind bars, and that guy is outside. And in such a scenario, I think in ARC business, public sector just can't do. I was, in fact, fortunate when I was doing SASF, because we also did quite a lot of things which maybe on a, if you go back and see, I think many of the decisions were excellent. In fact, one or two cases we revived so well. I think if I can take names, one is, what's that, our steel company in Orissa, and Bambino Agro and all, this hugely, it was revived by me. Perhaps SASF brought them to this level today. Mesco, steel company I was mentioning was Mesco. I mean, Mesco was really winding up in Delhi High Court. We took it out from Delhi High Court. High Court, in fact, asked me, send me a mail saying that what are the safeguards you want to revive this company. In fact, Harish and I sat together, did the set of safeguards we want. Today, the company is doing so well. In fact, unless you do these things, perhaps if CBI or somebody goes back, we have exceeded our brief in some of these cases. I don't know. So I think bad bank is not a great idea that way in the public sector. It should come in the private sector. I would think large ARCs, because in a banking system you need around 500 crore capital minimum. So I think any ARC which has 500 crore capital, maybe more than 10,000 crore AUM, should be allowed to work as a bad bank. Though I don't know what are the benefits of a bad bank. What benefit you get, statutory benefit or regulatory benefit, I don't know. If you ask me, I don't know that.
Yeah, you're an asset management company as well, Edelweiss. So whenever there is investment in this ARC, so what kind of the interest or kind of the benefits been offered to the investors in terms of the IRR? Because there are different kind of investment. You do your investment is sometime the asset, sometime in the ARC. So wherever the private investors pump money in your Edelweiss, so what was the approximately IRR you have, it has been generated by them through you, as far as the ARC investment is concerned by your group?
No, ARC investment in a distressed asset, IRR is different, and the investor, see there are two types of investment. One is the ARC investment, purely buy an asset under security receipt structure. If you want a small amount of capex, ARC gives it. Any additional funding given, you look at around 20 to 22% IRR. Any additional funding. So we are more than an ARC. Actually, Edelweiss, as you rightly said, Edelweiss AMC, work along with our asset management or funds. We have a couple of funds. Our funds are also looking at, looking at investment in the asset, fresh funding, maybe for capex, maybe for working capital. It will be a sort of priority funding.
I've gone through your different. Hello.
Yeah.
Yeah, I've gone through your different models in terms of the IRR been offered by your group. So sometimes it is 12, 13, 14. So as far as the ARC is concerned, the investors can get the more benefits out of this ARC whenever there is investment of the ARC.
12, 13, 14 may be other. We are not only ARC, we have other asset management also.
Okay.
Yeah. Mutual fund and all. What you must be talking of that. We have a global asset management group which is dealing in those assets.
Okay. Thank you.
Okay, if you have any questions, you can direct them to Mr. Anthony over lunch. We're slightly behind schedule, so I'd like to, on behalf of all of you, thank Mr. Sibi Anthony for a wonderful presentation with live cases that brought this entire presentation alive. Can we have a huge round of applause for Mr. Sibi Anthony? I'd like to request Mr. Aman Kanjlia, Senior Director Conferences, ET Edge, to present Mr. Anthony with a memento as a token of our appreciation.
Thank you.
Thank you. Thank you, Mr. Anthony.
Yeah.
Thank you, Aman. We will now break for lunch and reconvene at 1:30 sharp for the post-lunch session. Enjoy your lunch.
Thank you. Yeah. Yes, sir.
Nice.
Thank you, sir.
Brilliant. I need to catch you well.
Sure.
Welcome back, ladies and gentlemen. Thank you for taking your seats on time. As I mentioned earlier, feedback forms have been placed on your tables. Kindly ensure that you fill in those feedback forms in full. Your feedback is important to us. Additionally, an incentive is that we will have 2 lucky draws, and there will be 2 lucky winners at the end of this session. So kindly do the needful. It is my pleasure now to invite on the dais Mr. M.R. Umarji, former Chief Advisor, Legal, Indian Banks Association, for his presentation titled Perception versus Reality, Many Rules and Statutes but Less Recovery. Ladies and gentlemen, kindly put your hands together for Mr. Umarji.
Good afternoon, ladies and gentlemen. For a post-lunch session, the topic on which I am going to speak is quite boring, and I will try my best to keep you awake. There are many rules and statutes, but less recovery. What is the reality in regard to this recovery position and how the laws are operating is the issue which I propose to discuss. One basic law which is applicable for recovery of loans is the Civil Procedure Code, the process of filing a suit in a civil court and proving your claim in accordance with the Evidence Act. The process involves examination of witnesses, cross-examination of witnesses, proving documents, and it's an elaborate procedure which is prescribed by the CPC. And at every step, there may be some challenge or something. The person who is wanting to delay and defeat the effort of recovery can find faults and challenge, file an appeal, get a stay order, and the process goes on. The normal time taken for a recovery through a civil suit, because after getting a decree, there is a process of execution of decree. That again takes its own time. So it is about 7 to 10 years that you ultimately are in a position to execute a decree and recover the money. This is still relevant for banks and financial institutions because the debt recovery law doesn't apply to claims below 10 lakhs. DRTA Act applies only to 10 lakhs and above cases. So if your loan recovery is less than 10 lakhs, you have to go to the civil court to recover the loan. Within the civil suit procedure, there is a procedure called summary procedure, which is applicable if you are filing your case based on a admitted liability, like a demand promissory note is signed by the person. So you can claim the amount promised to be paid in a demand promissory note or any other bill of exchange or a guarantee document. On such documents, if you file, the elaborate procedure for proof of claim, etc., is not applicable, and there is a speedier remedy provided in the Civil Procedure Code. But it is because of the delays of this system that in 1993 it was decided to pass a separate law for setting up debt recovery tribunals for recovery of loans and advances given by banks and financial institutions. This was with the idea that ultimately the loans given by the banks are out of public deposits. Recovery of that loan is in public interest. So therefore, a special tribunal was set up called Debt Recovery Tribunal. The Civil Procedure Code is not applicable in the process of recovery which is prescribed for the Debt Recovery Tribunal. So the tribunal is only required to follow principles of natural justice in the matter of conducting the proceedings for recovery and then recover. It is
although these provisions are made that the CPC is not applicable, there are various problems that are arising in the matter of conducting the proceedings for recovery before debt recovery tribunals, and there are again delays to such an extent that they are almost coming on par with the civil courts. That's the position in the debt recovery tribunals. But nevertheless, it is true that if it takes 7 to 8 years to recover through a civil suit, it is about 3 to 4 years if you are recovering through DRT. And the process is shortened, and the time taken is also less now as compared to the civil suits. The only problem in DRTs is that it is applicable to banks and financial institutions as defined by the law, by the Recovery of Debts and Due to Banks and Financial Institutions Act, RDDB Act. So all the like NBFCs below, if they are not systemically important, they are not covered by the debt recovery law or the SARFAESI Act, and they have to go to the civil court only for recovery of their claims if it is not declared as a financial institution for the purposes of debt recovery law. As far as housing finance companies are concerned, they are declared as financial institutions for the purpose of SARFAESI Act, but they are not financial institutions for the RDDB Act. So therefore, if they have to recover, apart from if there is a shortfall, after selling the security, for recovery of that shortfall, they have to go to the civil court only. They can't go to the DRT. So this is the position as far as DRT Act is concerned. The pecuniary limit is 10 lakhs and above. If you come to the SARFAESI Act, the pecuniary limit is 1 lakh and above. So in case of security taken for a loan, you can recover that loan if it is more than 1 lakh. There are certain exclusions under the SARFAESI Act, like it doesn't apply to pledge. It was also not applicable to a transaction of hire purchase or financial lease, where instead of giving a loan to the borrower, the lender buys the asset and gives it on hire or gives it on lease. But the ownership, title, retention in that asset remains with the lender, and it is deemed to be a secured lending transaction. And therefore, in the recent amendment which was done to the SARFAESI Act, financial lease and hire purchase transactions have been included in the definition of secured credit, and they are treated as equivalent to secured lending. Similarly, money raised by a company by issue of debentures or any other debt securities and creating a security interest in favor of the investors by setting up a SPV or a trustee, and the security is created in favor of debenture trustee, then that debenture trustee is also recognized as a secured creditor, and the law is become applicable to such debenture trustee. So therefore, if the debenture holder is not paid, he has an additional remedy of enforcing the security given in his favor by empowering the debenture trustee to take possession of securities and sell them under the SARFAESI Act. Now, this is another important amendment which was made in the SARFAESI Act. Now, SARFAESI Act about the impact of recovery as far as SARFAESI is concerned, there is a misconception that there are number of stay orders being given. The process of SARFAESI Act requires that you have to make an application to a district magistrate or a chief metropolitan magistrate for the purpose of taking possession of secured assets. When that application is made to the collector, he is the collector who is a district magistrate also, it takes months and years together to get that order for taking possession of assets. In the process, the entire process of recovery under SARFAESI is delayed inordinately. This is true in some cases. It does happen that the district magistrate has so many other responsibilities that he doesn't get time to deal with these applications by the banks. But nevertheless, these approvals are being given by the district magistrates, and the process is operative and working. One very important aspect of the SURFACE Act, which is not appreciated, is that the very fact that the bank has a power to take possession of secured assets in the event of default by itself acts as a deterrent to ensure that payments are made on time. This is best illustrated by the sector of housing finance. In the housing finance, the default rate is less than 1%. As a result of prompt payments which are being received of housing finance, the interest rates on housing finance have gone down. Most of the banks are reducing the rates of interest, and the finance for buying houses is available at a very cheap interest rate. And this is all because of efficiency of the recovery process which is provided by the SURFACE Act. Now, therefore, if bank issues 100 notices under the SURFACE Act, 90 borrowers come to the negotiating table for discussing a settlement and repayment of the loan in installments or whatever proposal the borrower has. Whereas the remaining 10 start finding out ways and means how the action can be challenged, how it can be delayed, how can we stop it. And then there are various issues being taken up, that the property mortgage was a Hindu joint family property. Other members of the joint family did not give their consent to create a mortgage. Therefore, the mortgage is invalid. It can't be enforced. And there are so many other objections because the whole process involves compliance with certain detailed procedure, and the borrowers are trying to find out some defect in that procedure and challenge the action, saying that this is invalid because this particular procedure was not complied with. It may be a thing like the auction sale notice is to be published in 2 newspapers, one in vernacular and one in English. In one of the case, the notice published in the vernacular, the text was in English. So this was challenged that this is non-compliance with the requirement of the rules, and therefore the sale is invalid, and the court declared the sale to be invalid. Now, this is how the borrowers are trying to find fault with the system and try to challenge the actions of the banks and financial institutions and delay the entire process. But nevertheless, if you see the RBI report on trend and progress of banking, it is meant they have compared the recovery done by the banks through the process of Lok Adalat, Debt Recovery Tribunal, and SURFACE Act. Out of the total recoveries made, 75% of the recovery comes through SURFACE Act by issue of notices under SURFACE Act, and remaining 5 or 7% under the Lok Adalat and balance in DRT Act. That is the efficacy of the SURFACE Act, and this is also very important in the context of insolvency code coming into effect. It is still relevant because there will be situations where a secured creditor can recover his loan by enforcing security without resorting to insolvency proceeding, particularly in cases like housing loans or vehicle loans, where the loans outstanding may be such that by selling the vehicle you may be able to recover the loan. There is no need to go for insolvency and no need to declare the borrower as insolvent for the purpose of recovery of your loan. So therefore, it is in all over the world, the secured creditor rights are protected. Secured creditor law is very much in force and continues in spite of the insolvency code. Although in our code there are certain provisions which are beneficial to the secured creditors if they sell the securities through the insolvency process, and if they sell it independently on their own, there are some disadvantages. So that's a separate issue, but this is the position of recovery under the SURFACE Act. According to me, the whole problem in the system is the mindset of the trade and industry to avail credit as much as possible for as long as possible. And do not honor commitments to pay on due dates. It never happens that person pays on due date. A simple thing like if you are buying inputs for your product from a small scale industry, so many laws have been passed for this purpose to ensure that you make payment to that small scale industry on time for whatever you have purchased from them. For that also, auditors are required to mention in the balance sheets of the companies whether there are any dues of MSME sector which remain unpaid, and they are required to pay interest on that amount. That interest paid by the industry is not admissible as a expenditure expend from the total income of the company. All these provisions have been made, but the problem of not making payment on time continues. Now, answer to this is the Insolvency Code. The Insolvency Code has made a provision. The code is in two parts. One is applicable to companies. For companies, the pecuniary limit is 1 lakh and above. Non-payment of a debt or any other liability of 1 lakh and above, a petition for insolvency resolution can be filed. As far as companies are concerned, the jurisdiction is national company law tribunals set up under the Companies Act. As far as individuals and partnerships are concerned, the jurisdiction is debt recovery tribunals set up under the debt recovery law. Pecuniary limit for individuals and partnerships is 1,000 and above. As far as companies are concerned, the provision made is quite stringent, that if a company is liable to pay an installment of loan of 5 lakhs today, and it commits a default and does not pay that amount, tomorrow the application for insolvency resolution can be filed against the company. The NCLT is only supposed to verify whether the default has been committed or not within 14 days. If it is confirmed that the default is committed, the NCLT will pass an order for insolvency resolution, and the insolvency practitioner shall be appointed, who is supposed to take possession of all the assets of the company. He is supposed to take over the management of the company and operate the company as a going concern. Thereafter, he is supposed to appoint the creditors committee, which will substitute the board of directors of the company and continue to operate the company as a going concern till the resolution plan is prepared, which is approved by 75% in value of the creditors, and then it is submitted to the NCLT for its approval, and after the approval of the NCLT, the resolution plan will become operative. This is to be done within a period of 180 days, during which period there is a moratorium. During that moratorium, no action for recovery under the DRT Act or the SURFACI Act or the civil suit, no type of action for recovery can be taken against the company during the moratorium period. This moratorium of 180 days can be extended by another 90 days if the creditors request for that extension, saying that we are unable to complete the resolution plan and we need to extend need extension of time. Another 90 days extension can be given by the NCLT at the request of the creditors. This is the position under the Insolvency Code. Now, the one problem in this entire process is that at no point of time there is a provision in the code itself of giving a notice to the company before obtaining such order. Notice is not there for default of repayment of the loan, nor there is a provision for notice for filing a petition for insolvency resolution. Only thing made in the Insolvency and Bankruptcy Board of India is established. That board has made some regulations for insolvency resolution. In that regulation, they have made a provision that the petitioner shall forward a copy of the petition filed by him to the company. This provision has been made, but there is no further provision as to what happens after service of that notice. Will the company have a right to come to the NCLT and say, file its own say, and object or protest against the proposed insolvency order? All those provisions are not there. This is just a subordinate legislation saying that a notice will be sent to the company. Now, this is the ground on which the law has been challenged in the High Court, challenging its constitutional validity, that principles of natural justice are not being followed before passing this order, and the matter is pending before the High Court in regard to the constitutional validity. Any law that has been passed in the past for reforms like this has to undergo the challenge of constitutional validity. It was so with SURFACE Act, it happened with DRT Act, and this law also will have to face that challenge, and if necessary, certain modifications may have to be made in the law, but finally it will have to be tested as to whether it is constitutionally valid or not. Because one other important aspect of this notice is that if the petition is filed by an operational creditor is any supplier of goods or services to the company, if he files it, he has to give 14 days notice. If an employee who is not paid, if he files it, he has also to give 14 days notice to the company. But if it is a financial creditor, he is not required to give notice. The rationale and logic of this is that you are a company, you are a corporate, you are having expert employees and auditors, everybody. You know that you have borrowed money. You also know that you are liable to repay the installment on a particular date. You are also aware that you are not able to pay that installment and you are not paid. So it is apparent that you do not have the solvency to pay that installment. Because you do not have the solvency, application for insolvency is filed against you. So where is the question of giving notice and asking you to explain why insolvency petition should not be filed against you? You are yourself aware that you have committed a default. You are liable to pay it on this date and you are not paid. So this is the basis and rationale for not giving notice to the company, and it has to be seen how the courts will look at it and how they will decide this entire matter. But one very important aspect of this new code is that the mindset of delaying payments, not honoring commitments on due dates, will, in the process of implementation of this law, and when many petitions are filed, like if there are any bankers here, for instance, even ARCs, if there is a willful defaulter is normally a company which has capacity to pay but is not paying the installments of the bank. It is using that money for some other purpose, diverting the funds. It is has all the capacity to pay but is not making the payment. That is an ideal case to file an insolvency petition against that company. Because if you have capacity to pay and you are not paying, you would not like to lose your assets. Possession of assets will be taken over by the insolvency practitioner. Your management will be taken over by the insolvency practitioner. Instead of losing control and possession of your assets, you better pay off whatever is defaulted rather than allowing somebody to take over your entire enterprise, including the management rights of that enterprise. So this is one of the reasons why a new practice of payment, new system will develop where everybody will start making payments on time and ensure that no insolvency petition is filed against them. This is going to be the effect of the insolvency code. It depends on how its validity is declared and how it is implemented in practice. So this is going to be a major transformation which is going to take place in the system, and insolvency code has other new changes which are getting introduced in the system, which will also have to be adopted and accepted by all concerned. A simple thing like whether the company should be liquidated or a resolution plan should be approved. BIFR and all used to take such a long time to decide on the viability and pass orders for approving the plan and all that, rehabilitation or revival plan. Here the decision is left with the creditors committee. If 75% in value of creditors decide to approve the resolution plan, the NCLT is bound to pass an order approving the resolution plan. It is not asked to go into the merits and demerits of that plan and whether it can be approved or not approved or what purpose it serves. If the 75% in value of creditors approve, the NCLT has to approve. If they do not approve, NCLT has to pass an order for liquidation. Here the issue arises as far as the judiciary is concerned. Our judiciary is used to, there is a recent judgment in Madras High Court which says that when a winding up petition was filed against the company, the court said, Madras High Court, that we won't pass an order of winding up because it is like signing a death warrant of the company. And we won't pass it merely for the purpose of recovery of some small amount of loan which has not been paid by the company. This is the mindset of the judiciary also. From there, you will have to shift to pass an order of liquidation if the creditors do not approve the resolution plan. Now, this change also has to come about. Many of you must be here chartered accountants and practicing professionals. There is an added responsibility being given by the insolvency code. You have to act as insolvency practitioners, take possession of assets, run the company as a going concern. Tomorrow you may have to run a chemical factory making hazardous chemicals or a poultry farm. And you must know how to feed the birds. So it is going to be a challenge for the profession that how do you manage this type of responsibility which will be taken over by you. Because although it is at the instance of the creditors that you are taking over, the code is casting that responsibility of operating the entire resolution plan by the resolution professional. That is the accountant or a company secretary or an advocate or a cost accountant. So therefore it is going to be a responsibility. It is going to be a challenge to find right kind of persons who will be working with you, who have knowledge of how to manage a particular kind of business which you have taken over. That will also be another challenge which will have to be met to make the code successful and operative. Of course, there are many of the chartered accountant firms who have this expertise in their practice in other countries, and they know how to do these things. So it should be possible to train people and get these things, set up this entire practice within a short time. And with the experience which people have in the other countries, it should not be very difficult to undertake this kind of responsibilities for the professionals. But this is one of the challenges which is to be addressed after the code really becomes effective. The other provisions made in the code relate to setting up information utility. Now this information utility is supposed to maintain records of all loan sanctions, loan repayment schedules, and defaults committed in making payment of the loans. This data is to be made available with the information utility. It would mean that all the banks, financial institutions, NBFCs, HFCs, everybody will have to start sending data to this information utility who will maintain it. And when the petition is filed for insolvency, the NCLT or the DRT will be verifying whether the default is committed or not from this information utility. So this is yet to be set up, and the regulations for that are getting made. But this is one area which is yet to be addressed by the insolvency board. So the insolvency stringent provisions for taking possession of assets, in my view, is going to result into a better recovery for the entire financial sector. And better recovery of non-performing assets will be seen in the coming days. and the industry and companies will have to ensure, and this will equally apply to individuals and partnership firms, where also there is no provision for taking possession of assets, but the insolvency orders will be passed against them. So with this new law which has been introduced, I expect that there will be a much better position in regard to the recoveries in the defaulted loans. Thank you. I'll answer any questions.
Yeah, we'll take just a couple of questions because we are well over time, and then you can direct your questions to Mr. Umarji offline too. So if we have a couple of questions, yes, one here to this gentleman. Can we have a mic sent across to him, please?
I'm Harish Chandra from Edelweiss. My question, actually it's not a question, it's a doubt only. It seems that there is a conception that bankruptcy law is law of recovery. And whatever understanding we have is that this is a law of revival. So would you be able to clarify this, sir? Thank you.
See, it is both. One part of it is that basically in case of any insolvency, where there is a default in repayment of any amount due and payable on a particular date, an insolvency petition can be filed, but that petition is for insolvency resolution with a moratorium of 180 days. This provision is made for individuals and partnerships also. So therefore, the creditors will be bound to examine the viability of the enterprise, whether it can be, there can be a resolution plan, and whether the insolvency can be resolved. This is bound to be conducted in each and every case where a petition is filed. So therefore, it is a law intended to ensure that units which are viable are turned around and a plan is prepared for them to revive and resolve the insolvency. As far as debt recovery is concerned, you see, the law is very peculiar. The provisions in the Companies Act relating to winding up of companies on grounds other than non-payment of debt continue to be operative. So there are two separate kinds of petitions for winding up, liquidation. One is for non-payment of a debt, and the other one is for, say, non-submission of balance sheets to the registrar for 3 years. That's also one of the grounds for winding up. That can also be filed under the Insolvency Code. That will be under the Companies Act. Insolvency Code is only restricted to non-payment of a liability or a debt.
I've got a question. In fact, two questions I have. One is regarding, in fact, both are regarding the insolvency professional. Can the promoters, after the insolvency professional has taken over the management of the company, subsequently sue the insolvency professional saying that he has not acted professionally and he has messed up the operations much more than what he would have done had he been in the management? And are there any protections for the insolvency professional? And second question is, who prepares the resolution plan, the insolvency professional or the creditors?
See, as far as the protection of actions of insolvency professional are concerned, all actions taken in good faith will be protected. But if he has deliberately done something wrong, he can be questioned, and even action will be taken by the Insolvency and Bankruptcy Board of India, which has prescribed a code of conduct and regulations applicable to, and there is a insolvency practitioners agency, another company which is managing this insolvency practitioners conduct and code of conduct and all that. So actions can be taken by them also. So long as you are acting in good faith, no action can be taken against you. If there is any other charge against the person, then it will be inquired into and handled. What was your second question?
Who prepares the resolution plan?
The resolution plan, you see, the insolvency practitioner is supposed to collect all the data, the assets, liabilities, balance sheets, and other relevant data required. And creditors will prepare that. And you see, the old management is also expected to cooperate and work with the insolvency practitioner. So I expect that unless there is a cooperation from the company itself, this is not going to work out. The company will have to sit with the insolvency practitioner, and because ultimately what is the resolution plan? That you are defaulted in a loan, whether you will pay it, when will you pay it, how will you pay it, and how you think that you are capable of generating the surplus to service that loan. This is all you will have to establish, for which the involvement of the present management will be required. The managing director and other finance officers and everybody will have to be involved in preparation of that plan. They will have to propose what do they propose to do, and then the creditors committee will consider it and approve it. It is not like BIFR that you are operating agency and you do everything, keep on following with the company, ask them to submit data, they don't submit, they don't do, and the matter goes on dragging for years together. That's not the situation. Here there is on the one hand, there is time limit of 180 days, and if you don't do it, you are going to lose your entire company. All the assets are going to be sold. So you are bound to cooperate with the insolvency practitioner and see that a plan is worked out which is acceptable to the creditors. It is the company which is supposed to do it.
I have one question.
I'm sorry, we can't take any more questions because, like I mentioned, we would take only 2 questions. I'm sure you have many more questions. You can direct it to... So if you could just stay back on the desk, please. I'd like to, first of all, thank you so much, sir, for a lovely presentation. And thank you, Archana, for presenting a memento as a token of our appreciation to Mr. Umarji. Thank you so much, sir. Please direct your questions to Mr. Umarji offline. Before we move on to the second panel discussion of the day, I once again request you to fill in your feedback forms. Use the time during the panel discussion, and in half an hour, the hostesses will come around and collect the feedback forms. Kindly fill them up in full. Your feedback is important to us, and like I said, there will be a lucky draw where we will have 2 lucky winners. We will now move on to the second and final panel discussion of the day, titled The Changing Role of ARCs, Law Firms, and Credit Rating Companies. I'd like to first call on the desk Mr. Tarun Bhatia, MD, South Asia Kroll. Welcome, Tarun. And now to the other panelists. Ms. Sonia Putta, Associate Partner, Solomon & Company. Welcome, Sonia. Mr. Harish Chandar, Executive Vice President, Edelweiss. Welcome, sir. Mr. Sharad Bhatia, Managing Director, Multiples Alternate Asset Management. Welcome, Mr. Bhatia. Mr. Vinayak Bahuguna, Chief Executive Officer and Managing Director, ARCIL. Welcome, sir. I request the moderator and the panelists to stick to the time limit. And over to you, Tarun.
Thank you, and good afternoon, everyone. I think that was a very enriching session by Mr. Umarji, in a way like a master class on insolvency and bankruptcy code. And clearly, a lot of questions around that subject. We'll be fortunate to have people who represent the industry and the law firms who are actively involved with IBC. We have a strong panel. On my extreme left is Vinayak, banker, and now the MD CEO of the our oldest ARC of the country. We have Saurabh Bhatia with us, who again has experience in banking and now represents Multiples, which is a large private equity, homegrown private equity, and getting into stressed funds. Mr. Harish Chandar, again a banker, especially with legal background, and now working with Edelweiss ARC, the largest ARC in the country. And we have with us Sonia Putta, representing Solomon, who'll share her perspectives about how the industry is kind of shaping up especially in light of the changing regulations around stressed assets and bankruptcy. Quickly, I represent Kroll. We are globally, one of the largest risk consulting and corporate investigation firms. Our association, and our experience in the stressed assets reflect that traditionally the equity investors come to us before they get into an asset to understand are they taking the right risk. Unfortunately, the creditors tend to come to us after they have taken a risk and the risk has gone bad. And we are working actively with banks today on resolving stressed assets, especially in identifying where the promoters are tracing assets. And we are clearly seeing the changing regulations influence the way banks want to operate, the way they are looking at ARCs, the way they are now exploring private funds which are coming into the country to decide how they want to deal with stressed assets. What I thought is, to begin, I'll ask each of the panelists maybe for 2 minutes to share their perspective. The topic is the changing role of ARCs, law firms, and other intermediaries in the industry. So I'll start with Vinayak, but if each one of them can share their perspectives of how their industry and their particular company is evolving and the roles that they are, the change of role that they'll witness. And maybe from there I will get into specific discussion. We will like to ensure that the panel gets deep insights around the real issues rather than the academic issues. So with that, Vinayak, please.
Thanks, Tarun. Very briefly, I believe there are a few things which have changed very materially over the last 12 months. And these will drive and determine how the industry shapes up into the future. Shining new law, the bankruptcy law, amended Sarfazi Act is one, which obviously on the face of it provides more teeth and better ability to realize. Two, changes in government policy which allow freer movement of international capital into the country, full ownership rights. I think that is another positive trigger for the market here. Specifically in terms of development of skills, a starting point in the resolution professional bodies being sort of certified over a period of time and acquiring some basic skills to take it forward would be the other third positive aspect of the change that I see. From our perspective, we believe the landscape will change and change very rapidly when all things settle down. And a lot of things need to settle down: information utilities, bankruptcy board, the professionals involved in the trade. But assuming all of that to fall into place over the next 18 months, what will change, particularly from the context of the code, is speedier and definite decision making. And I think that's what I'm looking forward to.
Thanks.
I think, again, let me begin by saying that NPS and ice cream cones are both synonymous. The longer one holds on to them, the faster they melt. And what has happened in the past is probably that we have held on to the NPS for too long. We have waited for the value in the books of the sellers to be written down to a value where the intrinsic value in the business is lost. And it's only at that time that, as lenders, lenders have resorted to sale. Let's probably, the timing at which it is sold is something which is really critical. And I think even the bankruptcy code has realized that there's need for timely action, and the first default is the time that the action needs to be initiated. Let's hope that, we have seen in the past a lot of legislation, all with good intentions, being framed. But ultimately, it turns out to be a proverbial road to hell. I hope this, while with the best of intention this has been enacted, it's different this time.
That would be a hope I would be seeking. One more factor which probably I would like to highlight is that in the past, whenever assets have been sold, the objective is always the seller seeks to exploit the regulatory arbitrage which is available, and therefore NPAs are sold not at fair values, but they have been sold at values in which books have been marked, in which they have been marked down in the books of the seller. And this suited both, because the ARC sought to make money through, or they sought to earn profits through management fees, whereas the banker's expectation was a resolution. And this is something probably because there was virtually no alignment of interest between the two. While it suited both of them, it did not meet the ultimate objective for which the ARCs were constituted. And I think one way which probably, yes, I agree that the new guidelines going forward will ensure that SRs witness a quick demise. Probably that's the way I look at it. But nevertheless, SR, I believe, as an instrument is not a bad instrument. It still could be carried on. But to bring about alignment of interest between the seller and the buyer, probably the management fees is something which one could do away with. And, ARCs seek to make money through greater carry than through the management fees. Probably I'll stop at that one.
Sorry. Yeah. I think if you see ARC industry, which is just 13 years old, has seen more upheavals than perhaps, anybody would see in 13 years. So in 2003, this industry started. So no capital requirement. As agent of banks, take the loans from banks and try to recover. So 2006, suddenly RBI brings in 5% capital have to be put in by the ARC when they purchase the loan, without providing means to ARC to raise the capital. And then comes 2014. So ARC is required to put in 15% of capital. So 3 times of that. And if you say 15 times of, or more than 15 times of what it initially started with. But again, not providing any mechanism for ARCs to raise the capital, which has been sorted out now. Now, if you ask me, sometime in April 14 itself, we started seeing some signs from RBI that the role of ARCs or the industry as such is going to change significantly, and which is now changing. So therefore, we started our preparation at that point of time and started looking at funds, where from we can get the funds. So that is how now today we are sitting at about $2 billion of US dollars, which we can invest into this business. Okay. Now RBI regulations are already out. From 1st April 2017, mostly SR sales, which is typically called, will be at 50-50. 50% cash will have to be given by ARCs, and after 2018 it will be 90% cash, and thereafter it will be 100% cash. So therefore, ARCs which would have capital available with them would still have the role. But I would say that fine, ARC as an entity perhaps would be there, but then ARC cannot have that kind of capital. So therefore, ARC would need fund support. So therefore, the funds would come in. And today RBI allows anybody to buy NPA from bank. It's not necessary that only ARC can buy NPA from bank. Funds can buy, NBFCs can buy, AIFs can buy. So any kind of investors body which is constituted can buy. So I think a significant change in the role of ARCs is coming, and maybe by 2020 we will see completely different picture of ARCs in the country.
Thank you. Sonia, your views as a law firm.
Of course, I'm from a litigation background. So what happens is what we see with the new IBC, with the bankruptcy code, a lot of acts which have already been in place, which have been there for such a long time, have now taken a step back, and it is all now the focus is on IBC and how it is going to progress not only the debtors but also the creditors. And as has been pointed out by the earlier speaker, that the focus is not just on ending the company, it is about revival of the company, and it is moreover about recovery, and so that it can be in a position that the debtors can benefit and the creditors can benefit. It's not just as we said that it is going to be a corporate debt of the company as it is in the case of a winding up. And as the IPs are going to come in, the insolvency professionals, I see that a lot of role change for law firms, cost accountants, chartered accountants to come in and take their place, because as a company, you are very closely associated with the company. When the professionals come in, you can see it in a different manner, where you can not only look at the benefit of reviving the company, but also for the creditors to be benefit out of it. So that's what I see how it is changing.
Sure, thanks all of you. So I think clearly a couple of themes emerging. One is, insolvency and bankruptcy code remains the focus area. I mean, like we were earlier discussing, it's been termed like a masiha for the stressed asset industry, and that's something I want to, definitely talk about. But briefly, Harish, you mentioned a point, and it's slightly debatable, and we have two ARCs, we have Sharad with us. You mentioned, the 13 years, it's been a turbulent kind of a process, change in regulations, and and of course, we now have insolvency and bankruptcy code, where both creditors, ARCs, and hopefully some of the borrowers would look at it as a resolution process, and it's, as I said, a masiha. But a counter to it also has been that, is this technically the end of ARC as a business model, because there are funds which are coming in. As you said, 50-50 is the approach, so you need as much cash as you issue SRs, you need large capital. So what, how do you then, define an ARC today? I mean, is it, or everybody out there who plays in stressed asset is an ARC? So how does the role of ARC in itself evolve, with this IBC? Is it really a masiha, or is it actually questioning the very existence of this industry?
No, I think, what should I say? Solution providers to the debts of the lenders are required. Okay. Name may be different. Today you call them asset reconstruction companies. Tomorrow you may call them distressed asset funds or stressed asset funds or special situation funds, etc. Or maybe specific AIF models for specific assets. But there has to be capital which can go into these kind of assets. Now, if I coming to this little bit on IBC. Now, this was one question which arose when IBC was passed, whether it is end of ARC.
Right.
And I think the question which I asked Mr. Umarji is that whether IBC is recovery mechanism or IBC is a revival mechanism. Now, say yesterday one bank has declared results, and the bank has said that they will take 200 cases to IBC, okay? Because there are so many cases where borrowers are not cooperating, businesses are not running, and we want to liquidate them through the IBC. So I do not know whether IBC is a revival process or IBC is a liquidation process or recovery process. Not liquidation, but recovery process. To my mind, IBC is a revival process. It binds parties. Today, I have a situation which has been discussed by Mr. C.B. Antony in the morning, where we hold 85% of the debt, but 15% is not agreeable.
Right.
Okay, so solution cannot be found. So if I take that case to IBC, 75% is the rule. So 25% is bound by that.
Right.
And I think Mr. Umarji has very rightly pointed out that there is a compulsion on the borrower also, promoter also. If he doesn't cooperate with the resolution process in arriving at or finding a solution or formulating a plan which is acceptable to that body of creditors, 75% of creditors, he runs the risk of going into liquidation. So it's not that earlier situation where in High Court he could, continue, prolong it for longer time and say that only this creditor is there who is just 2% credit holder and I have so much other credit. So that would not work. So if you ask me as an individual and as an organization, we place lot of faith on IBC process, and we believe that this will really turn out to be a very, very good law, and a solution can be found under this law.
So I just want to continue with that question on role of ARCs. Yeah, so I just wanted to. You also mentioned a comment around management fees versus resolution process being the driver of income. So could you share your thoughts on this?
Fine. Okay. Let me take the first question as to what is the role which the ARC could play consequent to the bankruptcy code. What is it that ultimately, yes, we are forecasting, and all the hazards of forecasting are inherent. So basically, with that caveat, my guess is today, if the ARCs are able to aggregate the debt, they would probably have a meaningful role at the high table. Assuming that they fail to aggregate debt, you are reduced, the status is reduced to that of a lender, any other lender at the table.
Right.
But I think ARCs probably, I see, and the role of ARCs will gradually change to where they work much earlier with the borrower. Even when the initial signs of stress are identified, the default may not have happened, but a pre-pack is something which is agreed, which is common abroad. So that by the time, if there is a default or so, the ARC is in a position to aggregate the debt and bring a meaningful solution. And ARCs work along with other insolvency professionals to actually facilitate a meaningful, either a meaningful revival package. That's the way I would put it. That is probably, I think, would be the desired role. Ultimately, yes, one is optimistic, cautiously optimistic, I would put it. Hopefully that the ARC would, the bankruptcy code this time, as I said, should be different.
But do you see a level playing field where people like you, come in as funds versus ARC have, their own regulations to follow, capital allocation, capitalization? How does that change in this environment?
Let me put it this way, that the regulation does not, forbid ARCs from raising independent funds. There is nothing in the regulation which prevents ARC from raising funds. It's the question that what is the capability of the ARC to raise funds, and for that ARCs will have to build up a track record through successful resolution, which has, rightly or wrongly, it has not happened in the past. As a fund manager, if I go to the market, I have a track record or I have a perspective in which I say that funds would be raised. Similarly, everybody who is trying to attract funds for the revival process, we will all have to demonstrate a track record. At the same time, yes, funds and ARCs will have to work very closely together to be able to revive. The ARC and funds both have to coexist. That's my
right.
That I would believe that there's no option but to them. See, there are some things, for example, the enforcement ability. Probably, should things go wrong, a fund does not possess. It resides only with the ARC.
Yes.
On the other hand, access to capital is probably which fund with deep pockets would bring in. So I see a fair amount of synergies in both working together.
I want to bring you in here. There was a mention of recovery versus resolution, and RCL has now a 13-year history. And at least my understanding is there has been a successful, redemption of SRs as well. Question is, over these 13 years, what has been a more successful demonstrated model within ARCs? Has it been resolution or has it been recovery? Has the ARC industry been able to revive the companies which they have acquired as assets from banks, or it's largely been recovery, and generate the returns?
Okay, so I think the short answer is that a large percentage of assets managed in the industry over the last 10 plus years have been liquidated, assets stripped, sold. And there are fewer instances of companies and businesses which have been restructured, but that trend is growing. part of the reason I would attribute to the fact of the quality of the assets that have been put to sale. And I think it was the earlier panel where somebody suggested that banks kind of potter around for as long as they can before they finally decide to let it go, and perhaps it's quite late by then. That could partially be the reason. The other reason could also be the inadequacy of depth of resolution professionals who understand restructurings and working with distressed companies. It's quite a different animal, and I don't think it is for anybody who's had investment experience can seamlessly move into the space and claim that they can replicate that success, because the level of difficulty, uncertainty, and the forces that are conspiring against that business at a particular point of time could be quite overwhelming, and that formula doesn't necessarily work. So that kind of summarizes it.
But, one of the things in our observation...
Just one...
Sorry, sure.
I mean, it's very easy to make a charge that, ARCs have resorted to liquidation. But, let's also look at what time were the assets sold to ARCs. By the time most of, except for the first lot, probably, which was sold in 2003. After that, whatever sale of assets has happened to ARCs, there has been virtually no business value resident in those assets.
Right.
If you sell an asset which has probably, the unit is closed for 15 to 20 years, you cannot expect business value to be revived out of it.
Right.
It's only the value which resides in the underlying assets which have to be liquidated. So probably, it's unfair to say
there was
that...
no juice left itself for them to revive. But, one of the things at least we have observed in our role when banks and ARCs, and now funds come to us, we have seen, the whole auction model, where when ARCs are trying to get in, they get those 2 weeks to really assess the asset within that time, confirm whether there is value, put a, penny on the table and hope they get it, versus at least the fund route which we have seen is, the discussions actually go on for 2 to 3 months for them to really see value. And in our experience, which is also reflects a differentiation of, because you have done 3 months of due diligence and you really understand the intent of the promoters to either revive or, not pay. Resolution process has been more common in stress funds, versus in ARC, it's more of what's on the table. I have capital already allocated to me, so let me see what's the best value I can derive. And, of course, Sharad said the assets which have been put on the table really have no value left, but that's been our observation. I just wanted to bring, Sonia, you into this picture, IBC.
Yes.
Sorry,
if you can allow me 1 minute on this point which you have made. You see, I think you will have to see the regulation which is governing the buyer of the asset. Okay. Now, if a fund is buying the asset or investing in the asset, and say let us taking it from the banks, it's an NP asset. So there is no regulation which is preventing him, that fund, from going to the borrower, promoters, going to the plant site, conducting due diligences which you had talked about of 3 months to 6 months, etc., etc.
Right.
Okay. So the regulation which governs ARCs, even today, it states that you cannot approach promoters. Okay. So if the bank, which has put the asset on sale, is able to facilitate a visit to the plant, only then the ARC would have the chance to visit the plant.
Right.
Otherwise not. So therefore, the bank's ARC's diligence has to get restricted to the data provided by the bank in the data room.
Maybe it's not a level playing field from that perspective.
So,
access.
So that is why you find that kind of difference. Okay. And yes, when it was 5% capital or 15% capital, so this kind of arrangement or regulation was possible to implement. Okay. Now when as an ARC, as a player, if I have to put 100% cash into an asset, so I would want Reserve Bank of India to change that regulation for me as well. Sure. Because my capital at risk is now significantly going up, and it is equivalent to any fund's capital.
So is that something the industry has already
so therefore
raised with the regulator?
No, but it will gradually come. See, now regulator is saying from 1st April 17 it will be 50-50. So at that point of time only that these issues will come up. And see, we are a very small industry. You please understand this. ARCs are 13-year-old, very small, a few ARCs. So we do not have that kind of, like voice that, if we approach RBI or write to RBI, that RBI would listen to us.
Sure.
Because we do not have that kind of, banks have IBA. So from IBA, banks can approach Reserve Bank. And then Reserve Bank listens to that because that's a larger sector to which they are regulating. It's a very small sector. It's a very
So there is a need
sector.
to kind of, reach out. Sorry, Sonia, coming back, IBC, from a practitioner's perspective, how do you see one, the role of law firms? But even, I wanted to add to that, our country has seen BIFR, SICA, CDR, SDR, S4A, now IBC. From your perspective, what is so different here that, it should work? Because the relative success of the previous measures have, been very limited, if I must say, and maybe that's the reason IBC has been put in place. So from how you see, what's happening on the ground, what's your take on this?
As what we said, there were so many options available earlier, and as we had been discussing, it was kind of a forum shopping for where to go, how is it that which place is going to be the best way for the creditors to extract the money out. Now with IBC coming in, I think it's become a little more progressive, because in IBC it's not only the creditors who will be involved, the company is also involved to a certain extent. As we said, that we don't want the company, it is a resolution more, and resolution is what is more important. The revival of the company is more important. So when we would go to SICA, the most difficulty with the judiciary is the time which is being spent by the ARCs or the companies or the creditors. I think with the time span which is given for under the IBC, that is what is going to help control the resolutions and the revivals of the company. And that is what we are looking at nowadays, is the shorter the time, the better, the more effective the results should be. But how much it's going to be effective is something which we need to see and understand, because it's quite nascent to even comment on how effective it is going to be, definitely. But I think with the strength of the judiciary increasing a little bit, it would become a little better. It would be for the benefit of both, as I said earlier.
So two questions. One is, is law firm brought in purely from a litigation perspective, or today do you need to come in to handhold literally the entire 180-day process, because there's an IP.
Yeah.
You have to work with the borrower, you have to work with the bank. So
yes.
how is that happening, and do the banks or the other stakeholders appreciate that aspect?
Yes. So here, if a law firm comes into picture, it has to take into consideration not only what the creditors are saying, but also what the stakeholders are saying, because as I mentioned earlier, it is going to become a little difficult for a company to say that this is the way I can progress, or this is the way I can revive the company. But if we look at it from a professional point of view, because both parties are able to give their views, and both our parties views are considered before implementing it, you placing it before of course the board finally, but before that the creditors committee is there, the IP is there, the utilities information is there. All this comes together, and the law firm, because they have a wide array of practices within it, it can consider all of it and then give a solution to both the parties.
Like, I wanted to bring you into it. You mentioned, in your opening remarks, how IBC is definitely, and a positive event for the whole stressed asset industry. And I know it's early days. We understand 6 to 7 cases have been referred, under this code. One of the borrowers has also gone to High Court against the specific order, but only time will tell how the process works. But this whole use of IPs, and again, 1,000 IPs have registered themselves. But I'm taking note from what Mr. Umaji said: take control of assets, take control of management, operate the company as a going concern, work with the creditors in the resolution process. Do you think that kind of talent is out there for you to, work with as you look at a resolution process, or at the end of the day it's going to be much more that, the acquirer themselves have to really put the nuts and bolt in place, because this is a lot of accountability. And there are, of course, other issues of remuneration, indemnity support. How do you look at that, and could that itself be a, a question or a stumbling block for IBC to operate?
I would hope not. But it is too early to say. I did make the point that this process depends quite heavily on the skills and the abilities of the IPs. And I suppose to the extent that they are missing today, these will have to be necessarily sort of brought in, either through international transfers or just from reskilling and learning. But if I may sort of move sideways for just a moment, following Mr. Umaji's clarification on the question that the gentleman asked about whose responsibility will it be to put the plan in place. And my sense is, and I don't know the nitty-gritties of the law, but my guess is that if it were to be left to the creditors committee, then I suspect this will lead to similar behavior as we have seen in CDRs and stuff, which might mean that the interested creditors might want to force fit things into a very tight glove, whether or not it fits. It was my understanding that this responsibility is with the resolution professionals, and I hope to God it is. Because part of the question about what will happen to the industry and which directionally, where is it going to move, I think capital will come into the industry when they find optimal solutions, not solutions that bank or banks or other creditors believe will work for them. And that's the point I think Sonia mentioned right at the beginning. This is less to do with the creditors, more to do with the underlying business and the borrower. And I think that's the important starting point. You fix the borrower, the problems at the creditor levels should hopefully get fixed.
Right.
And to that extent, I do hope and I pray that this process is not left and managed by the creditor groups. Sure, they can vote on it, but if they are called to put these plans together, then I fear in some part of my thing that it may lead to similar disincentivized behavior.
So Harish, I also wanted to kind of
Yes,
add
sure.
something to it and ask you specifically. You mentioned earlier also, I think Sibi also mentioned, Edelweiss is not just an ARC. You're more of a financial house. In your experience, both while taking exposure through ARCs or taking exposure, is it easy to have a resolution process without the promoters themselves, and IPs take the lead? They work closely with the lender, put a process in place, bring in professional management eventually to run the company, or that's a nice dream, and then 180 days later you wake up and you realize you cannot move much without the promoter being involved, because Indian, the Lala rule continues to operate in India. So how do you look at that?
No, I think one quick point on the resolution professional. Besides the multidisciplinary competency which a resolution professional might need to perform his functions, he needs a lot of infrastructure.
Right.
If you go through the law, everything is online. Your claim submission is online. Voting is online. Electronic voting is there. So whether the resolution professional who has taken registration with the board has set up this infrastructure. 3 days back, I encountered this problem with one resolution professional who has already been appointed. I sent my claim thrice because the resolution professional called me up and said, my mailbox is full. Okay? And there are not many claimants in that company. So you would have operating companies where you will receive thousands of claims. Each worker will file his separate claim. Okay?
Right.
So I will rest there for the time. Now coming to the other point which you are raising. See, this is a fact that in India, promoters are also the managers of the businesses. Okay. But this is also a fact that the kind of stress which they have faced in the last 5, 6, 7 years, and the kind of stress which lenders have also faced on that count. So lenders have also forced the hands of the promoters to step back. So now you have 18 cases where lenders were able to take 51% equity. So that is majority control. And by law, they have the right to change the management. And lenders are, as somebody said in the morning, Abhijay Gandhi said, that promoters are today ready to hold significant minority, okay, and allow the new guy to come in and operate. So therefore, the promoters are ready to come on table, discuss, and finalize things and make plans. I think I will slightly differ with Vinayak on this, which he says that, you know, if it is left to creditors committee, then it would be like CDR and kind of stuff. I think the main, according to me, the mainstay of this code, IBC, is fairness. If your any action will get challenged successfully, it will be on the ground of fairness. Now let us say, you know, I'm having 75% of the control in the creditors committee, and I make a very unfair scheme to the operational creditors. So obviously that will be struck down by the NCLT. They will not accept it. So therefore the fairness towards all the stakeholders of the company is a must, including the promoters.
I think the questions are, of course, you know, I don't want to dwell into it. We have 4 minutes. Is in India, across, you know, industry, the fairness is always the most difficult to prove. And, you know, I mean, it's very early days, but we have been, you know, at times been inquired whether we can be an IP and so on. And we, of course, are very independent professionals providing forensic and investigative support from outside. But a big question always is, you know, who is the IP ultimately going to represent? The promoter or the creditor, while, you know, they are empaneled and so on. So I think the fairness question is something, you know,
Perhaps both. I would say, as Sharad mentioned, pre-packs. See, our IBC is largely borrowed from UK law. And in UK, pre-pack is the order of the day.
Right.
So you sit across the table, work out with the promoters, all the lenders, all the creditors, all the other stakeholders, keep those stakeholders into consideration, make a pre-pack and then go. So let us assume that you want to cut down 3 businesses out of 5 and only 2 are the core business you want to operate. Do you think that in 180 days which are given to you in IBC, you will be able to achieve all this and find buyers at the right price? No. So therefore all this pre-pack work
will have to come together. Right.
So this code has come into effect from 1st of December.
Right.
So there are people who have been able to hit that ground by 15th of December. You can ask me on 10th of February also, I am not ready with one single case, though I have 400 companies which I am eligible to take before the IBC.
Sure.
Why I am not going? Because I want to go there fully prepared with my answers to everything.
Right.
Because thereafter it's a
process.
It's a process.
Kicks in, sure.
So every day, every passing day reduces from 180 days.
So that one quick question I wanted to just bring here, you know, the listing of SRs has now been mentioned, and, you know, we have 2 ARCs who have an experience in SR. Is multiple going to go and acquire SRs from the exchange if listed? Is that the way how you see the industry moving?
I mean, let's go back to why SRs were initiated at the first place. It was to protect the bank's books. And so far, you know, the NAVs have been technically managed. So unless, you know, the NAVs have been marked down, I don't see many banks offering their SRs for listing. That's the first. At the same time, you know, I believe there is no dearth of capital available to acquire SRs at the right valuation.
Right.
But let me also add, you know, today, as multiples. For example, if I aggregate, let's say I have 80% of the SRs with me, I would ultimately want to work with the ARC of my choice. The regulation does not allow change of one ARC to the other. So that is also a change which I think needs to be done, along with enabling,
Sure.
the listing of SRs. That's a suggestion I would.
I'm sure Vinayak
I think,
and Harish have a view on
I
your
think-
first comment.
I think I would say, I mean, at least from my portfolio, if I speak, and there is one example in the past which is there in the system where SRs were sold and purchased by somebody. Okay, so in my portfolio there are 7, 8, 10 assets.
Right.
Involving something like 7,000-8,000 crore of SRs, which can easily get listed and at the face value. So it's not that, and it's not necessary that you need to buy the loan at discount only. Okay, so you need to work the asset, as we mentioned, Mr. Anthony mentioned in the morning, that if I am acquiring an account where I cannot realize 150% or 160% of the price paid, I would not want to acquire that account. So why such SRs would not get listed and traded and
Yeah, I think the only challenge, sir, is, for almost 30 years, corporate bond market has been trying to mature through listing, and we are not seeing much action in SR. As we discussed, just because an SR is listed, you still want to know so much about the underlying asset, whether exchange is the solution or not is really a question mark, but I think we are...
At the same time, probably I'll add that, for example, when in the past assets have been acquired, there is very little information which is available to enable even ARC to make a decision.
Right.
Would there be, with scanty information, it would all reflect in the pricing of the asset.
Sure. So just, last comments, Vinayak, and we'll end with Sonia, lady on the panel, so last word with her, but any last comments that you want to leave with the audience?
I think the only thought in my mind is we exist to serve the banking industry, in a sense. And our raw material comes from the banks. And I do believe that when banks will be adequately incentivized to put assets on sales which can find trade possibilities with the ARCs, that's when the market will.
Thank you. Sir, last comment.
Probably, I only hope history does not repeat itself. And, probably
All
the
of us
bankruptcy
hope that
code
way.
is, this time, we can actually say this time is going to be different.
Yeah, I think if you ask me, BFR had worked good for some years. DRT has worked good for some years. SURFACE is now established process and is working very well. And I have full hope, and I am quite positive that IBC will work very well.
I think the law is progressing, and IBC is one of the most progressive laws currently which is in effect. And as Sir says that all of the acts have worked. So we'll see how this works. We hope for the best, and we try to hope that it works well for both the corporates as well as the bankers and the lenders.
So we hope the transition is as smooth as from Dhoni to Kohli, rather than anything else.
Yes.
Thank you all of you. Thank you so much.
Thank you.
We're open to questions.
Already the question is we are not able to recover any money from the borrower. So 2-3 corporate guarantors are doing business well. Whether we can proceed against them under this IB. Already guarantee invoked, suit filed, everything is there. So what is whether we can, if we can, whether without notice, now already we have invoked, everything is there. And the corporate guarantor company is running very well and they can pay 700, 500 crores. So, give me answer whether it is a IBC is a recovery proceeding or a revival proceeding.
Sonia, you are on the block. Can it be done?
I think we'll have to study the law a little bit more. Clearly, it does not really give the option to do that right away. but I think we can make a way to, because as it is said, it is not just for the purposes, it is for the benefit of the creditors as well. So I think we should be able to work our way to get it. Currently, I wouldn't say that it is clearly open for us to do that.
You've got a lawyer's answer.
Operational creditor is filing application, and when sufficient assets are there to stall the entire proceedings of in the SARFAESI, whether SARFAESI is a block to IBC or IBC is a block. So I have a asset of 100, I think 80 crores is value, asset is 100 crores. So we are going on the SARFAESI, and in the meantime, the borrower put a dummy through operational creditor file, where within 14 days your NCLT is taking, yes, and without notice, and this is happening, and register professional saying, you see NCLT order, the claim should be filed. So it is going on lingering, whether it is dragging or you say this is a very progressive legislation.
Again, I would say that it is all going to depend on how we are going to portray it. Your question is whether an operational creditor can go to NCLT when a proceeding is already before the SARFAESI, before the DRT. It is possible, and that is what it is happening. It would happen, I would say, but how the court's going to view it is all going to.
No,
I'm sorry.
Okay, I would try to answer what you're saying. So I think let's not lose sight of the impact which bankruptcy can cause on a corporation. Okay. So just to stall the SARFAESI. So I think you are aware stalling SARFAESI is not that difficult in this country. So for that you don't have to, resort to such a disastrous thing. Okay. So SARFAESI can be stalled. Yes. Once you reach bankruptcy, SARFAESI is stopped for 180 days / 270 days / whatever time. Fine. But the end product can be complete liquidation of the company. So therefore, that particular corporate will have to decide whether he wants to play this gamble.
Okay, we don't want for liquidation, we don't for resolution. We go for recovery of our assets. If we go on dragging,
so that's why my question was to Mr. Umarji, whether it's a recovery law or it's a revival law. To my mind, it's a complete revival law and it's not recovery law. When you will see the provisions relating to liquidation and the election which secured creditors have to make, you will find that ultimately you will have to take out your security and enforce under SARFAESI or under DRT. So therefore, this law is not available to you for liquidation of the asset.
No, I think just to be fair to the panelists, this is a Q&A session, so let there be a question and let them answer it to the best of their abilities, rather than it become a discussion, so that we can probably take another couple of questions here. Please address whatever concerns you have with him or with the panel after this. Yeah, just to be fair to everyone in the audience. Do we have another person who would like to ask a question? That's it. This will be the last question.
Yeah, my question is more to RCL MD. I was talking to one ARC company. As far as this management takeover is concerned, they are not very keen, because their apprehension is that the employees who will be retained by the company after takeover, even after takeover, they may sabotage in running the company and they may create severe legal bottlenecks. Means, how do we sort out this kind of problem? Because we are losing a tool, like in the process.
Vinayak, the question was to you.
Oh, it is to me. I think there's no point speculating at this stage, frankly. I think the new act provides the ability for creditors to take possession. And the required person who does it, we would imagine, we must ensure are people or organizations who have the ability to manage assets on the ground. Otherwise, you might be better placed leaving it with the borrower. But I think it's early days, and I wouldn't like to speculate. I think it could be done. There would be specific instances or businesses where this would be more difficult. There would be other businesses where it's a little easier. As Mr. Umarji also referred, in a complicated chemical plant, you have other sort of liabilities attached. Would you want to take it as a resolution professional? Maybe, maybe not so. There will be different strokes for different balls, I think, as they're served.
Thank you so much. Let's have a warm round of applause for the entire panel. Thank you, Tarun, for moderating this panel. I request Mr. Mahendra Menezes, Project Director, ET Edge, to kindly come up and present each of our panelists with a memento as a token of our appreciation. Okay, so while they pose for the group photograph, I have the feedback forms with me. Thank you so much for filling them in. Is there anybody's feedback form that is still with you all? You can just hand it over to the hostess nearest to you. Okay, so while this is happening, I'd like to ask in this audience, how many people with work experience of 35 years and more? If we can have a show of hands. 1, 2, 3, 4, 5. Quite a few. 40 years and more? 40. 40. Gentlemen, can you kindly come up on the dais, please? Both of you. No, there are 2. Yeah. No, it's 2. So 40 years and above? Okay, we have Mr. Anthony, and sir, your good name? And Mr. Suresh Joshi. Okay, what we're going to do is, we're going to get the 2 senior-most members in this very august gathering to pull out the lucky winners, yeah, of the lucky draw.
Normally it's the other way around, no? Children are normally taken out first.
Oh, okay. Okay. So eyes closed.
So, I want to take 1.
Okay. And you, sir. So please go ahead and announce the name.
This is Mr. Ramanamurthy Malla.
So can we have Mr. Ramanamurthy Malla? Is he in the audience? Okay. He went outside. So should we pull out another winner or? Okay, we'll wait for him to come back. Sir, what is the name that you have? Could you kindly announce that?
Mr. Ankur Mitra.
Okay, Mr. Ankur Mitra. Come, Ankur. Congratulations, Ankur. You are one of the winners of the lucky draw. When it comes to the, yeah, Ankur is here for the feedback forms. Please give him a big round of applause. Thanks, Ankur. And Mr. Ramanamurthy, oh yeah, there you are, sir. You just were going to miss it. Yeah. Yeah. Congratulations, Mr. Ramanamurthy. Thank you, Mr. Anthony, for doing the honors. Okay, great. We've had a wonderful day. Thank you for being a wonderful audience. And to propose a vote of thanks, I'd like to call on the dais Archana, if you can do the honors.
Good afternoon, everybody, and what a great session we had in the morning, since morning. And since you are all professionals who are all about accountability and accounting, I think it's time well invested. So before I get on with nomenclatures, a huge round of applause for all our speakers. I think we can have more energy, people. While the lunch was nice, but I think our panelists, our speakers did a great job in making sure that as India is building itself, we are laying down a very strong foundation of how the companies should be, and like one of the speakers said, that we have to embed failure somewhere in our system, because we as a country, we as a culture have been shunning failure. And since Economic Times works with industries all across the segments, this particular aspect is something that we see in every segment. That a lot of entrepreneurs, a lot of businesses across segments, across their value chain, across their evolution cycle, are extremely scared of failure. Maybe because of the compliances, maybe because of the pressures, but this, all of you, this particular segment can make a difference in their lives. And I think there should always be that clause of opting out. And I think we had great discussions on that. So, me for one, very, very poorly informed on this sector. So I learned a lot on this topic. And I think we have a long way to go. Like all the speakers almost said, that this is still a very, very young sector. I think we are in our teens. So since we are in our teens, it is also time to probably grow with the strength that India needs and the Indian companies need. So with all this and more, I would like to thank all of you for being part of this. And when we were remodeling this event itself, the Remodel in India, we thought that which are the aspects that we can include to make sure that we make this segment very strong. And I was sitting here and I was reading your reviews about the feedback that you have given. A lot of you have appreciated what we have done. There are a lot of suggestions, and we're very, very thankful to each one of you, because we'll work on those strengths and the weaknesses that you have put across and make sure that the next edition of Remodel in India is much more stronger. And we'd like to thank all our partners who have made this show. We have a presenting partner, Edelweiss, who we worked with very closely to create this. Then we have associate partner, Trilegal, State Bank of India, and of course, this whole thing is webcast live. We have 24 Frames Digital to thank for that. And at the end of it, thank you all. It was a great morning session, and have a great time, and more power to you as you construct and reconstruct the Indian businesses. Thank you, ladies and gentlemen.